Yeah. Good morning, my dear students. I hope everybody is doing great. This is CH in Mahegde, your learning partner for corporate accounting and financial management. So welcome to one day marathon on this subject. Can you please confirm first that my voice is audible and the screen is visible? Yes. Okay, great. Thank you. Thank you, everyone. To begin with, I will be trying to summarize all concepts on corporate accounting and financial management in this session, which is not going to be an easy task. The syllabus is very vast. I'll try my level best to cover it. First of all, I will be following the material, the summary material, and some problems contained therein. For that, please message or WhatsApp the number, what is available on the screen, 9739 733 400. This will give you, or if you can message them, they will send you the PDF of the material, which will help you, which I will be using in this session. Which are the chapter I'm going to cover? Let me take you briefly. This is the material. I'm going to cover it. I hope you made a note of it. Or okay, let me do one thing. I'll just pause moments. And in case anybody wants to message it, so I'll just wait for a minute so that anybody wants to get the material, please message this WhatsApp number. Okay, I hope you made a note of it because based on this only I will be covering the materials. Okay, now let's go into the material. I'll be using that as the base. Okay. This is my starting point. Start where you are, use what you can, do what you can. That's the best we can do to our ability. These are the chapters you have, 19 chapters. Of them, quite a few of them are theory chapter. For example, first 3 chapters are mostly theory in nature. So, introduction to accounting, and then corporate accounting and accounting standards are theory in nature. So, I will not spend much time on these 3. I will give a brief overview, but I'll not be going in depth. Accounting for share capital, debentures, related aspects, I am going to solve maybe 2-3 problems from chapter. Consolidated financial statements, I will do one full-fledged problem with maximum adjustments. Financial statement analysis, I'm not going to solve any problem. I'll discuss theory. Cash flow, I'll solve one full-fledged problem. Forecasting of financial statements or financial analysis, maybe one problem I'll solve. Ratio analysis, one problem I'll solve. Forecasting, I will cover theory aspects. Introduction to financial management, theory aspects. Time value of money, basic concepts, maybe one problem. Capital budgeting, I'll try to cover one problem with maximum adjustments. Cost of capital, one problem with maximum adjustment. Capital check theories, one problem with maximum adjustments. Dividends, yes, one problem with multiple models. Working capital, one problem, overall estimation and other concept analysis. Security analysis, theoretical concepts we'll discuss. Operational aspects, maybe I will cover one problem again. So this is the plan, my dear friends. Most of the chapters, I will try to give an overview, brief discussion, summary discussion on all topics. Then on certain chapters, I'm going to take up problems. So this is the plan. I hope you are able to follow it. If you have any doubts in the YouTube chat option, please make use of it. I will try my level best to address it as well. Great. Let's go to the topic one by one. The first one, introduction to accounting. The objective of accounting is to record the transaction as and when they happen. Business does so many transactions and that gets reflected in financial statements. That reflection is the job of an accountant, the job of objective of the accounting. And we follow double entry system. That is the primary accounting methodology, which means for every debit, there has to be a credit. And how do you decide what is debit, what is credit? We will follow golden rules of accounting. Personal account, where name of a person will be involved, debit the receiver, credit the giver. If I give loan, let's say Krishna gives loan to Rama. Krishna is the giver, Rama is the receiver. So you are going to account or amount is receiving is cash. So the person who gives, that person account will be credited. The person who receives, that person will be debited. Real account is applicable for assets like bank balance, for property, machinery. Debit what comes in, debit what goes out, credit what goes out. Nominal account applicable for income and expenses. So debit all expenses and losses, credit all incomes and gains. After the class, will you make it public? I'm not sure about this. The management will take the call. I'm really not sure about it. I'm sorry, I don't know the answer. Okay, so what is the process of accounting mechanism? Double entry system is the primary one, which we need to understand. Personal account, real account, nominal account. Once you are clear about the golden rules, in fact, in the past exam, they had a theory question on golden rules of accounting. Every entry into books of account starts with a journal entry, where you are going to pass the journal entry. And from the journal entry, you prepare a ledger accounts, where you prepare the summarized format. For example, if the journal entry was cash account to bank account, in cash ledger, we write to bank, and in bank ledger, we write by cash. So from journal entry, we make it a ledger account. This process is called as posting. Anyway, nowadays, everything is automated, computerized. So things will happen in an automated manner, but in examination, you still need to know the basics. So from the journal entry, where we account it based on the sequence of events, where we follow for every debit, there has to be a credit, double entry system of accounting. We pass the journal entry according to the sequence of events in the chronological order, and then we group them by posting. That's called as ledger accounts. And then in that process, there will be many journal entries that you'll be passing. Like for example, bank, you give check to so many, you receive check from so many transactions will be there. So bank will have a balance. That's called as balancing in nature. Once you balance the ledger, what remains, the next step is called as trial balance. All the balances in the ledger accounts, we will group them. Net debit will come or net credit will come, and the trial balance should tally. Now, primarily, it will contain either an asset liability or a revenue and expense. So briefly, what are these 5 types of things? Let me quickly cover you. Assets means it's a resource owned or controlled by the entity, like computer machineries. Liability, what company has to pay, like creditors and salary payable. Equity, what belongs to the shareholder. Revenue, the income for the organization. Expenses, the cost incurred by the organization. So in the trial balance, if you have an asset and liability and equity, that goes to balance sheet. Revenue and expenses, we transfer that to P&L account. And then P&L account also comes in balance sheet, and ultimately balance sheet should reflect the accounting equation asset equals to liabilities plus equity. Okay, so I hope this is how the summary I'm going to discuss. When it comes to problem, we'll go slightly in a slow-paced manner, not too much slow-paced, because our objective is to cover the entire syllabus in one day. So we have to maintain that speed as well. Hope you understand. So this is what is primary first chapter accounting is all about. Now coming to the chapter 2, corporate accounting is mainly on preparation of P&L account balance sheet for company's purpose. It is given by Schedule 3 in Companies Act 2013. So if you take a look at Schedule 3, broadly, you have equity and liabilities. On the liability side, we have shareholders' funds. Then we have non-current liabilities and we have current liabilities. These are the three things on the liability side. Asset side, we have non-current assets and we have current assets. Non-current assets and current assets. So these three items you should know in liabilities: shareholders' funds, which comprise of share capital and reserves and surplus. Non-current liabilities, which is like long-term borrowings, long-term loan, debentures. Current liabilities, like creditors, we call it as trade payables, and other current liabilities like income tax payable or short-term provisions like income tax provisions. On the asset side, non-current assets, we have fixed assets. We call them as PPE now. We don't call it fixed assets. We call it as PPE, property, plant, equipment, like machinery and all. And also your intangible assets like goodwill, patents, copyrights. And current assets like basically ITC, you can remember, inventories, trade receivables, cash and cash equivalents, and other current assets. So first of all, how do you define this something as current and non-current? That classification based on the normal operating cycle. If it is expected to be receivable within the operating cycle, then it is called as current. If it is expected to be receivable beyond operating cycle, it is called as non-current. Normally, the operating cycle is taken as 12 months. Therefore, in general, if anything receivable within 12 months, then it is current. If it is beyond 12 months, then it is non-current. This doesn't work for old syllabus students, not entirely, because 60 to 70% the topics are common. So you will have relevance for you. I'm not entirely telling it is not relevant for old syllabus students, but this is meant for new syllabus students. So conceptual angle, you can also attend. Corporate accounting, financial management, conceptually, you'll be able to get. I think it also belongs to two different papers in old syllabus, right? So Schedule 3 of the Companies Act 2013 broadly divides assets into current and non-current, and liability side into current, non-current, and shareholders funds. So how do you decide the current, non-current? Anything receivable within the operating cycle is current, or payable within the operating cycle is current, and anything expected to be payable beyond operating cycle, and that is non-current. And normally we will assume it has 12 months period, and therefore it is in general we say operating cycle is 12 months. But if you want to calculate the operating cycle, you have to apply little bit of financial management concept. The financial management concept in working capital says inventory days, that is raw material days, WIP days, plus finished goods days, plus receivable days, debtor days, that is called as operating cycle. How long once you start a business and how long it takes for you to come back to the cash. That cycle is called as operating cycle. And few theory questions you can expect in exam. How does XBRL work? What is XBRL? Extensible Business Reporting Language. So nowadays, everything is available on machine. So in MCA, we have to upload our annual documents, annual filing. You're all company law students, you know it. After AGM is conducted, we have to file with the annual returns with ROC. Now, earlier it used to be in PDF format. In fact, even now for many companies, it is in PDF format. But PDF format is not really machine readable format. So the analysis cannot be done. Comparison cannot be done. So for that, XBRL system has been introduced, extensible business reporting language, where it is in machine readable format. There will be tags for every entry, every document that you upload. And therefore, the Ministry of Corporate Affairs can do lot more many analysis. In fact, I have been associated with the company which does downloading of all the companies from the MCA, and they do lot of processing and data analysis. So for them to take the data from many companies, compare the ratios, compare the performance, compare the financial position, what is their profitability, what is the revenue growth, in a machine readable format is XBRL. And XBRL is not applicable for all the companies. It's mainly for like companies like listed companies and having paid up capital of certain amounts and turnover of certain amounts. They have to file in XBRL format. Mainly it is machine readable format, and it helps in analysis post filing by the companies. So this is broadly the corporate accounting elements. Again, we can't do entire chapter in detail. Hope you understand. We are doing the marathon session, right? So this is the second chapter, which focus on, again, preparation of financial statements based on Schedule 3 of Companies Act 2013. Then you have accounting standards to be followed. So what are these accounting standards? Mainly for the purpose of standardization purposes. Accounting policies are there. For example, we have inventory method of valuation. People can follow first in, first out method, or people can follow average cost method while valuing the closing stock, while valuing the inventory. There is nothing that this is correct or that is correct. According to the situation, companies can adopt accounting policies. But in certain situations, some standardization is required, for which accounting standards is used. So accounting standards, as the name suggests, standardized accounting policies, mainly facilitating comparison. Comparison of what? Comparison of the same company with its previous year transaction or prior year transaction, or the company's analysis with another company. For example, if you want to compare whether Infosys is performing well or TCS is performing well, their financial statement should be compared. And if you want to compare, they have to follow certain basic standards. If everyone follow their own standards, comparison will not be possible. So to facilitate comparison, accounting standards are issued. And accounting standards talk about 4 different aspects. Recognition, whether it should be recorded or not. For example, should we value inventory? Yes, it is for matching concept. That is recognition. Measurement, if you decide to value inventory, the recognition is yes. How much? The amount is measurement. Presentation, in which format it has to be disclosed. Like if you talk about fixed assets, we have to show what is opening balance, what is depreciation, what is closing balance. The format, the structure is given by presentation, and disclosure, other qualitative information like accounting policy followed for fixed assets, whether cost model, revaluation model, the depreciation methodology followed, whether WDV method, straight line method, and those things are called as disclosure. So accounting standards talk about broadly 4 areas. Then who issue the accounting standards? Broadly, ICAI used to do it earlier, and then MCA came in. So for companies, MCA accounting standards are applicable, and for non-companies, ICAI accounting standards are applicable. ICAI divided into level 2, level 3, level 4, and to whom it's applicable, that have given. That's the numerical part, like whose turnover is more than 250 crores, borrowing 50 crores, please go through it. That's not what I want to discuss in a conceptual manner. It is here. Anyway, once you get the material, you'll be able to revise it fast. So MCA divides into SMC, non-SMC. Non-SMC means small companies. SMC means small companies. Non-SMC means big companies. What do you mean by small companies, big companies? Again, it is listed here. So we have about 30 accounting standards. Some of them have been withdrawn as well. For example, 6 has been withdrawn, then 8 has been withdrawn. Some accounting standards are withdrawn as well. List of accounting standards are there. And I don't want to go to the accounting standards one by one. That's again going to take a lot of time. One theory question definitely you can think of from exam point of view is important is this convergence of IFRS in India. IFRS stands for International Financial Reporting Standards. IFRS, International Financial Reporting Standards. So many countries have signed an agreement that they will follow same accounting financial statements and standards. So that across countries, a company, multinational company, they will be having presence in many countries. To make the comparison appropriate, many countries have signed, we will follow similar method of accounting standards called as IFRS, IAS, International Accounting Standards. India also is a party to it. But India is one of the largest democracy. We have our own accounting standards as well. So we cannot simply adopt whatever somebody says. It will hurt our ego also, right? So India has taken the path of not adopting international standards. They followed the path of convergence of moving towards IFRS. Convergence basically means applying the IFRS in its broader sense, not by line item basis, by applying our own judgments. So that is what in India we have something called as Ind AS, Indian Accounting Standards. So broadly, we have got 3 accounting standards, I would say. One issued by, what do you call ACI, that's for non-corporate entities. MCA for corporate entities and MCA, Ind AS for bigger companies. So to whom this Ind AS applicable, I have given the chart here. So for companies net worth more than 500 crores from 1416 only, it became applicable. For listed companies and then unlisted companies more than 250 crores, listed everybody, unlisted companies net worth more than 250 crores from 1417 it's applicable. For unlisted companies having net worth less than 250 crores, MCS standards continues to apply. For non-corporate entities, accounting standards by ICI continues to apply. So I hope you got the basics of accounting standards chapter. Accounting standards are there mainly for the purpose of comparison, for standardization of accounting policies. Accounting standard covers 4 aspects: recognition, measurement, presentation, disclosure. In India, we have accounting standards issued by ICI for non-corporate entities, accounting standards issued by MCA for corporate entities, and if you cross net worth more than 250 crores or you're a listed company, you have to follow Ind AS. And what is Ind AS? It is a version of IFRS, which is in India, we have followed the method of convergence and not adoption. Convergence means applying the IFRS over a period of time and not following IFRS line by line item. So in India, we have taken the path of conversion, slowly moving towards adoption of IFRS. So this is the brief discussion on the 3rd chapter. I think first 3 chapters, we did not solve any problem. We discussed broadly the theoretical concepts from exam point of view. Going forward, you will see problems also being solved, like in this case, accounting for share capital. So what is share capital? As per Companies Act, it's a share in the share capital of the company. Like this, we can't understand. So when you think the company like let's say a pizza whole, you divide the smaller piece into so many companies that one piece is called as a share. So accounting for share capital, how does it take place? First, step in issue of shares is share application. Company invites the application from the public. So public has to fill the application, public has to pay for the money, and after that, company will do the allotment. So everybody who will apply, allotment may not come. Even recently, you have Bajaj Housing Finance, IPO coming. Many people applied. Everybody who applied have not got it. So first stage is application, then the allotment, and then the call money. So application is when shareholders gives money to the company and applies. And everybody who applied may not be allotted. If you don't get allotment, money will be refunded. And for few people, the shares will be allotted. It might be oversubscription, so it might be return and balance will be allotted. And it can also be allotted on pro rata basis. What is this pro rata basis? Pro rata basis means proportionate basis. For every 3 shares applied, 2 shares allotted in the ratio of 2:3. 2 for every 3. 2 allotted for every 3 applied. So this proportionate allotment is called as pro rata allotment. So once application is done, allotment is done, and then call money will happen. Call money means if the share face value is 100 rupees, application may be 20 rupees, allotment may be 30 rupees, balance 50 rupees is called as call money. Company may collect the call money immediately in first and final call or may spread it over multiple calls. Now, in this stage, the shareholder have the obligation to pay this amount not only in application but in all these stages. But in case at any stage, if shareholder fails to make the payment, cancellation of shares will take place. Suppose a shareholder paid the application money, paid the allotment money, but fails to make the call money. So whatever he has already paid, that will not be returned, and the shares will be cancelled and the shares will be issued to somebody else. This process of cancellation of shares for non-payment of money is called as forfeiture of shares. And whatever money received will be transferred to forfeiture account. And this may be reissued to somebody else at a discount, and the discount will be adjusted with this forfeiture, and excess money in the forfeiture will be transferred to account called as capital reserve. So this concept we'll understand with the help of a problem. So this is the question we have. So again, I'm just sharing this page. If anybody wants the material, please do message this number, send a WhatsApp. If you not got it, sorry, you have to contact the management. Okay, let me put up the question here. Anyway, so I'll also show the question so that, even though you don't have material, along with reading with me, you'll be able to follow the data. Mr. Herbal Tea Plantations Limited was registered with a capital of 1 crore, divided into equity shares of 100 each. The company offered to public 50,000 shares at a premium of 20 per share. Amount of share was payable as 25 on application, 50 including 20 premium on allotment, first call 20 and 25 final call. So does the total add up? Please check it. So they are having the face value of 100 rupees, premium of 20 per share. Premium is something above face value. So 100 plus 20, 120 should be the issue price. Please cross check now. Application 25 rupees. Premium, including a premium allotment amount, is 50. And first call 20, final call 25. If I add all, will it be 120 rupees? 75 plus 2500 plus 120. So 120. So this is the order in which money is received. Applications were received for 75,000 shares. 50,000 shares was offered. 75,000 shares are subscribed. Oversubscription. Shares were allotted to the applicants on pro rata basis. So what will be the ratio? 75,000, 50,000. If you applied for 75, you get 50. 3:2. Dividing by 25, 25. Kantibai, who was allotted 500 shares, did not pay the allotment money. He also failed to pay the first and final call. His shares were forfeited. Sheetal was holding 200 shares, did not pay the first call. Final call was not made. Okay. Final call was not yet made. Okay, good. Pass the journal entries in the books of the company. Now, as I told you, you have to solve it in stages. First application stage, then allotment stage, and then call, and then final call. Now, as far as problems are concerned, I've also taken most questions from the CS Institute study material. So in case you are not able to, we are not able to solve some problems, I'll show the solution of the institute so that we can do things faster. And you can also find it comfortable, because if I follow CS questions, study material questions, you'll also find it more relevant. Correct? Now, so what are the stages? Let's follow the problem in stages. First, let us understand about application. And then we'll focus on allotment. And then we'll focus on first call. And then we can focus on final call. And in this problem, final call they have not yet made. So we will not discuss about it, but there is a calls in arrears. Or there is a, what do you call? A forfeiture of shares. So these are the stages in which we'll discuss the entries one by one. Now coming to application. Okay, application of shares. How much money is received? 50,000 shares, so issued, 75,000 shares, and application money is 25. So 75,000 into 25. This is the money received. So if I calculate, 75,000 into 25, 18,75,000. This is the money received. And what entry you pass for this? Bank account, money is coming in. And on what purpose money is coming in? Towards share application. So you say to share application. And some people pass the ledger to share application account. And some people say share application and allotment account. Both are fine, interchangeable words. Let's say I'll call as share application. So money received will be 18,75,000. And if any money was refunded, then I would have passed an entry, share application to bank for money refunded. Allotment, pro rata allotment. And what is the meaning of pro rata allotment? Allotment of the shares on proportionate basis. So in this case, 75,000 shares were applied, 50,000 shares were allotted. So for every 3 shares applied, 2 shares are allotted. 75 is to 50. Divided by 25 means 3 is to 2. And balance money, because we are supposed to refund, we don't refund. Instead of refunding, we will adjust with the next amount dues. That is the beauty of pro rata allotment. So what is pro rata allotment? Allotment on proportionate basis. The excess money is not refunded. Instead of that, it will be adjusted against the future dues. So how much allotment will take place? In this case, 50 rupees, including 20 rupees premium. So 50,000 will be allotted. 75,000 is to 50,000. That is in the ratio of 3:2 basis. Okay, 3:2 basis. Okay, so what entry do you pass there? For first allotment due, and then you will have the allotment entry. So you are going to pass the share application and then share allotment. And if you're preparing only one ledger, then you do share application and allotment. To share capital towards face value and to security premium towards premium portion. So per share basis, what is the application money? Per share basis 25. Allotment money 50. And towards share capital, how much will be towards face share capital? 25 application and then 30 rupees in allotment, 50 minus 20. So 25 plus 30, 55 rupees is towards share capital and premium 20 rupees. You can see total 75 rupees tallied. And all these number, I'll multiply it by number of shares allotted, which is this number 50,000. So you got the process. Okay, now writing those amounts will take time. So what I will do, I'll quickly go to Institute solution and I'll show you that. This is Institute solution. So you need not take it down. You can quickly just follow it. Just 1 second. First, I'll show what Institute has given as their working notes. So shares applied for 75,000, allotted 50,000, 3:2. I explained this. Kanti by number of shares holding applied, excess money received. Okay, net amount received. Okay, this I'll come to it in a moment now. Let me explain other aspects of journal entries. Yeah. So first entry I told you, bank account to share application 18,75,000. That is 75,000 shares multiplied by application money of 25 rupees. And this transfer to share allotment account. I was explaining two separate entries, right? I was explaining one entry, share application, share allotment to share capital to security premium. Okay, Institute thought we will do one entry separately. So share allotment, share application to share allotment, share application to share capital to share allotment. Okay, they are also what they're doing is the face value of amount, they're transferring it to share capital. Excess money, they are accounting to the pro rata allotment, right? They are adjusting towards share allotment amount. Let me show the calculation here. How much amount you are going to get? 75,000 into 25. This is what is application money. How much is towards share capital face value, which is 50,000 shares allotted multiplied by 25. That is 12,50,000. Then balance the pro rata allotment, 25,000 shares into 25, and that is transferred to share allotment. So it should come in the next line. That is basically your pro rata allotment. Then share capital, the allotment money due, second stage, allotment money Allotment money was, what was the thing? Allotment money was 50 rupees, including 20 rupees premium. So look at the entry there. 50 rupees multiplied by how many shares? 50,000 shares. And that is 25 lakh. Share capital face value is 30 rupees. So 30 rupees multiplied by 50,000, and that is 15 lakhs. Balance 20 rupees share security premium. So 20 rupees into 50,000, and that is 10 lakhs. Okay, now how much money received? For receiving, it is bank account debits to share allotment. How much money was supposed to be received? Total money was 25 lakh. And in 25 lakh, some money is already received. Product allotment. So 25 lakh minus 6 lakh 25,000, that is already received. And then some money was not received on Kanti. And that amount also to be subtracted. And for that only, this calculation is given. So total money due 25 lakh. How 25 lakh? 50,000 multiplied by 50 rupees. That is 25 lakh. Allot money adjusted. That anyway, 50,000 shares multiplied by 25. Right? That is 6,25,000. That is already received. That will not be received. Then what was the money due on Kanti Boy amount? What about Kanti Boy information? Who was allotted 500 shares? Please be careful. Sometimes they tell you Kanti Boy applied 500 shares. Sometimes they'll tell you allotted. It's very important to look at the difference. Allotted 500 shares means how much the person should have been applied for. Applied allotment. If I take the 3:2 ratio, if you apply for 3 shares, you get allotment of 2 shares, 75,000, 50,000. And if you're allotted 500 shares, how much you should have applied? 500 into 3 divided by 2, 500 into 3 divided by 2, that is 750 shares. You should have applied, right? 750 shares. Now that is what they have given here. Number of shares applied, 750 shares. Now 750 shares for this 500 shares, that shares were allotted, and for 250 shares, the shares were supposed to be refunded, but instead of that 250 shares, they did product allotment. So 250 shares multiplied by 25. 25 was the call money, right? 25 was the call money. So 625 to 250 into 25, 6,250 was supposed to be refunded. And instead of refund, this is being adjusted. On 500 shares, call money of 50 rupee was due. 500 into 50, that is 25,000 was due. Out of 25,000, 6,250 already collected. So 25,000 minus 6,250, 18,750 is not collected. I hope you're able to get this number, 18,750, why it is not collected. So 25 lakh was the allotment money due, minus 6,25,000 already received, and 18,750 from Kantabai amount is not received. Balance 18,56,250 amount is received. Bank account debit to share allotment account. Then first and final call, first call, not final call. First call is on 20 rupees and 20 rupees is on 50,000 shares, 50,000 into 20. So amount due 50,000 into 20, and that is 10 lakh. Share first call to share capital, capital. This is called as money due. And then for money received, again, you're not collecting the money from two people. You're not collecting the money from Kanti Bai. You're also not collecting the money from Sheetal. So 500 rupees into 20 and 200 shares, 500 shares into 20 and 200 shares into 20. This much money you have not received. Let me show the calculations. Yeah. So how much money you are supposed to receive is 10 lakh. And in 10 lakh, you have not received money relating to 2 people. So that's what 200 shares, right? 200 shares into 20, 4,000. That is not receipts. And balance number of shares. Okay, they have not transferred to calls in arrears account, the share first call. Balance amount they kept in share first call only, but also you can do one thing. Instead of doing this only 9,90,000, you can do 10 lakhs. That first person, Kanta boy, that 10,000 rupees, 400 shares into 20 rupees. That also you can put in calls in arrears. In this institute solution, they have not put in calls in arrears. They have kept the 10,000 in share first call itself. Okay. Now last entry, coming to the cancellation, forfeiture. The forfeiture means whatever entry we have passed in the past will be reversed. So as far as the 500 shares is concerned, how much money received will go to share forfeited, and how much money not received will go to respective accounts. So as far as share capital is concerned, so far what is the face value that we collected on related to these 500 shares and 200 shares, totally 700 shares, right? For both of them we are cancelling. And how much share capital portion? 25 rupees. And then this 50 minus 20, 30 rupees. And then 20 rupees. So 30, 25, 20. That is 75 rupees. That is towards capital. So 700 into 75. Is that amount correct? 700 into 75. Okay, that is let me just calculate. 25, 30 rupees here, 55 plus 20 rupees. 50, 25. It should be 75 only. What institute has done? Okay, just give me a second. Okay, on 500 shares. Okay, 500 shares. Okay, I did on 700 shares. 500 shares into 75. You get 37 correct. 500 shares. I'm sorry, that's my mistake. Yeah. Then security premium. How much ever not received, only I should debit. Not received is relating to how many shares. Received means it's already in security premium. I'm not going to do it. So this person who was allotted 500 shares. Okay, I was doing for this final cause made. His shares were forfeited. Okay. Only the Kantabai shares were forfeited, not Sheetal shares. That's why not 700 shares. That's why 500 shares. So please correct me there. So 500 shares, premium of 20, not received. Therefore, security premium, 500 shares into 20, 10,000 was also not received. So debited. Forfeited amount, whatever money received. Whatever money received, forfeiture account, you can say balancing figure. Or if you want to calculate how much money received, we also calculated here, right? Total money received 500 rupees, 750 shares he has paid. 750 shares he has paid. Totally 25 rupees. Or what is the call money? 25. Yeah, 750 shares into 25 if I do. 750 into 25, you get 18,750. 750 shares into 25. Then share allotment, money not collected, we already calculated, right? Here also, so you see 18,750 money not collected, that is in share allotment account, 18,750. And call 500 shares into 20 rupees, that's still in call money, that is in first final call. If the shares were issued, then the discount will be adjusted and discount amount difference will be transferred to capital reserve. So this is a problem I want to discuss about issue of shares at various stages, including the premium and the forfeiture. Hope you're able to understand. I took the institute solution itself as the example. Okay, now let me go to the next question. Question number 2. Again, I've taken institute solution. So I'll take the help of institute solution to demonstrate the answer. Okay, so take a look at this question. This was the second question in our material, institute solution only. So easy for us to compare the solution. MS Limited issued 40,000 shares were underwritten. What is this underwriting of share concept? When company comes and issue the shares, public may not subscribe. There might be under subscription of shares. Over subscription of shares, pro rata allotment takes place, balance money may not be refunded, you might adjust against the due, like in the problem we have seen in the previous one. Underwriting means opposite. Under subscription of shares. Shares will not be subscribed by public. What will company do then? That is why there are some people called as underwriters. Underwriting. Okay. So which means if public don't subscribe, these people become the subscribers of the shares. So company get a guarantee. It's a kind of insurance contract. It's a kind of guarantee contract. So in case public don't subscribe, these people will subscribe. And in what ratio they will subscribe? According to the ratio as per their contract. Like in this problem, company issued 40,000 shares. P is telling, don't worry, I will take the responsibility of 24,000. Q is telling, I will take the responsibility of 10,000. R is telling, I will take the responsibility of 6,000. Totally 40,000. Even if public don't buy one share also, the company need not worry. These people will buy the shares. These people will subscribe the shares fully underwritten situation. Underwriters made the application as under P 3,200 shares, Q 1,200 shares, and R 4,000 shares. The total subscription, excluding the firm underwriting, including the marked applications, were 20,000 shares. So here we have certain terminologies to understand. One is called as marked applications. What is marked applications? So P said, don't worry, I will ensure I will buy 25,000 shares if public don't subscribe. But he does not said, I will only buy. On behalf of him, somebody else will buy. He is taking responsibility. He is not telling, I will only buy the shares. I will ensure to the extent of 24,000 from my side, shares will be underwritten. I take the responsibility. Does not mean I only become the shareholder. There is also one statement, I will only become the shareholder. That's called as firm underwriting. So what is firm underwriting? Whether the public subscribe or not, whether my people subscribe or not, I will buy, don't worry. That is firm underwriting. Then if people submit application to the company on behalf of underwriter, how will you know from this underwriter only person has gone? There has to be some proof, some evidence, some seal. Yes, that is what is called as marked applications. So in 20,000 shares, 3,200 came from Mr. P. 1,200, okay, sorry, not 3,200. That is firm underwriting. Marked application 4,000 shares. So in 20,000 shares, 4,000 came from Mr. P. 8,000 came from Mr. Q. 2,000 came from Mr. R. What is balance? 4 plus 8 plus 2. If I add 12 plus 2, 14,000. shares is from nobody else. That is 14,000 shares from these three people. That is marked application. But how many total you received? The total subscription marked application. Total subscription which written the underwritten PQ. The total subscription 20,000 shares. Now 20,000 shares. If you include or if you take out the 14,000, balance will come to 6,000. So 6,000 plus 3,200 plus 1,200 plus 4,000. Okay. So if I take the total subscriptions. So what is total subscription? Excluding firm underwriting. Excluding firm underwriting for included. 20,000 plus 3,200 plus 1,200 plus 4,000. Please do the total. 3,200 plus 1,200 plus 4,000 plus 20,000. So 28,400 is the total application received from everybody. And out of 28,400, 14,000 is called as marked applications. And what is marked applications? Where it is having the stamp of underwriter. So in 28,400, 14,000 marked applications were there. Remaining amount are unmarked. It does not have any particular person's seal. That is called as unmarked applications. So we start with gross liability. We subtract marked application, which is specifically given in the problem. We subtract unmarked application. We'll divide this in the ratio of gross liability ratio. 24,000, 10,000, 6,000. 24, 10 is to 6 means divide by 2. 12 is to 5 is to 3. Then any excess amount comes, that will be divided in the ratio of their gross liability. Now let me show the calculation as given by Institute solution. Gross liability 24,000, 10,000, 6,000. First line 24,000, 10,000, 6,000. 40,000. You understood? Great. Marked applications. What is marked application given? 4,000, 8,000, 2,000. So 4,000 we subtracted, 8,000 we subtracted, 2,000 we subtracted. 24 minus 4, 20,000 remaining liability. 10,000 minus 8,000, 10,000 minus 8,000, 20,000. 6,000 minus 2,000, 4,000. So you got this gross liability after subtracting marked application. Now you have to subtract unmarked application. So unmarked application will be not particular person. So we have to divide. So how do we got unmarked application? What is this 14,400 calculation? So you have received 20,000 excluding firm underwriting. So I have to include firm underwriting. So 20,000 plus the firm underwriting of 3,200 plus 1,200 plus 4,000. So this is actually the total application received minus what is marked. Marked application is 4,000, 2,000, 8,000, which is 14,000. So how much remaining you get if you calculate this way? 20,000, 3,200, 1,200, 4,000 minus 14,000, you get 14,400. This you divide in the ratio of 12 is to 5 is to 3. From the balance amount, you subtract. In this situation, I think one person you're getting negative number. 2,000 was the balance. 3,600 was marked application, unmarked application. 1,600 excess amount. Excess will be given into other two people in their gross liability ratio. So excess was middle person. So remaining was 12 is to 3. So 1,600 divided in the ratio of 12 is to 3. That minus will be given to them. So thereby 10,080 is the balance, 1,520 is the balance, and this is the liability, the number of shares. Underwriter should take the responsibility. And this is the net liability. Apart from this, they've already ensured that the firm underwriting means guaranteed underwriting. They have to buy themselves. So that is also being added. You get the total liability for the shareholders, the underwriters. One thing, let me tell you, in this problem, we have assumed that the this unmarked application includes firm underwriting. That's the indirectly we have calculated. Let me tell you logic of that. See, 3,200 plus 1,200 plus 4,000. So this is 4, 7, 8, 8,400, right? This is the total firm underwriting. And what is marked, if I say in purest sense, 20,000 minus these three. So this is 14. 8 plus 12 or 14. So 20 minus 14, I am supposed to get 6,000. So firm underwriting, I added to 6,000 and that is effectively I got 14,400. So in this problem, we have assumed, maybe institute, yeah, they have given the assumption. Firm underwriting treated as unmarked applications. You can also treat it as marked applications. If you treat as marked application, this will not be 14,400. This will be only 6,000. That 8,400 I will not include here. And marked application will be 4,000 plus 3,200. This 4,000 plus 3,200, 8,000 plus 1,200, 2,000 plus 4,000. Firm underwriting plus remaining marked application if you assume the firm underwriting as marked applications. You can assume both ways. I explained you both. Hope you're able to follow it. Okay, great. So this is regarding the share capital accounting, problems on issue of shares and problems on underwriting. There are also problems on buyback of shares, ESOP, or something like sweat equity, the ESOP and all. I will discuss in the chapter related aspects of company accounts. I hope this you are able to follow it. Okay. Then going to the next chapter. Accounting for debentures. Just give me 1 minute. Okay. So accounting for debenture and accounting for shares are similar in various aspects. One aspect, it is also having the steps of issue, that is application, allotment, application. That is one common thing. But what is the major difference between shares and debentures? Debentures are instrument evidence of debt, loan. Shares are not loan. Shares represents ownership. So debentures don't give voting rights. Shares give voting rights. Debenture carry interest. Shares don't carry interest. So debentures issue broadly journal entry, bank account to debentures. And debenture you pay interest every year. So interest account, interest expense account debit to bank. And when you repay debenture, it's called as redemption of debentures. So when you take loan, it is issue of debentures. When you repay loan, that's called as redemption of debentures. Now, as far as redemption of debenture is concerned, various methods are there. One is called as sinking fund method. Very simple, sinking fund. You will have an investment. When the redemption due date comes, you sell the investment. Whatever money comes, use it for redemption. Redemption means repayment. But one more area where usually students find it difficult is with respect to the purchase of own debentures. So for the purpose of purchase of own debenture concept, let me take a problem and that will help you understand the concept better. Okay, let's read the question once. XYZ Limited has 10%, 100 each debentures. Interest on debenture is paid half yearly on 30th of June and 31st of December. Company is not maintaining any sinking fund. On 1/4/2022, company purchased 500 debentures of 95 come interest for immediate cancellation. On 1/10/22, the company purchased 600 debentures of 90 each ex interest for immediate cancellation journalized. So this concept of come interest, ex interest is what you have to understand. Just give me one thing. I'll just put this in PPT. Second. I'm going to share the screen. Just give me 1 minute. Yeah, now got it. Yeah. Okay, so this concept of come interest, ex interest, let me explain. So what is really happening here? Company have issued debentures. I told you debenture is a liability. So it comes on liability side of balance sheet. So when I want to repay, simply what I do, I'll go to market and buy. In fact, in terms of shares, it's called as buyback of shares. So when I buy my debenture or when I invest in my own debenture, that's an asset. If I buy anybody else instrument, security, that is an investment. Investment in the shares of Infosys, investment in the debentures of HDFC Bank. Like that, I only invest in my shares or in my debentures. So that will be shown in my assets. And I'll already have a debenture liability. I have an asset, I have a liability that will be set off. That's called as cancellation. And one term you have to understand, cum interest and ex interest. Cum interest means cumulative of interest, including interest. X interest means excluding interest without including interest. So when you buy and sell debentures, what would happen? You might be buying and selling during the year. Now, interest is there in debentures, which might be paid in this case every half year once. So, if I sell during the year, but interest is getting accumulated. You understand, right? So June 30 to December 31st, interest is getting accumulated. Suppose you sell on July 31st. So June 30th to July 31st, 1 month interest, it is accrued to you. You are eligible. But when you sell it to somebody, they will collect it because on the date of December, they are the debenture holders. You got the point? When you sell the debenture, seller loses interest benefit. As a compensation, seller collects the money from the buyer till the date of interest due. So from the previous interest payment till the date of transaction, whatever is the interest accumulated that will be collected, that's called as interest accrued. And when they tell you come interest, it is 95 including that interest. And when they tell 90 X interest without considering that interest. But let me make one point clear. Just because if they say 90 X interest does not include interest, does not mean seller is foregoing. He is not giving up. He is not sacrificing. He will collect the money interest separately. 90 is only towards the debenture. You have to pay me interest separately. This is something like GST. You know, in some hotels, they say idli 50 rupees, inclusive of GST. You pay 50 rupees. And then in some other hotel, they say 40 rupees idli plus GST. So you say 40 plus GST, 45 rupees, maybe something like that. So whether they tell you including of GST or they tell you exclusive of GST, you'll have to pay GST. Like that, interest here. If they tell you come interest, that means this included interest already. If they tell you X interest, means this does not include interest and you have to add separately. You should not ignore the interest element. I hope you're able to follow it. How solve the problem in test yourself, problem 5 and 6. Those test yourself problems, I will not be able to solve now. You know, it's a marathon session. So please share me the picture to me personally or to the WhatsApp it is shared, right? They will share it to me and I will share the solution or I will clarify your doubts. Because particular problem, at this point in time, I'll not be able to solve. Hope you're able to understand. If time permits at the end, maybe I'll consider it. Okay. So they have 5,000 debentures, that is every year. On 1/4/2022, company purchased 500 debentures. So on 1/4/2022, own debenture purchased. Purchase of own debentures. Okay. So what is the entry you're going to do? Investment in own debenture. Investment in own debenture. Whatever is the purchase price. Then interest accrued account. Interest accrued account to bank. Or you can say simply interest account to bank. So when I say investment in own debenture, simply investment debenture, this will be excluding interest, or this I can say X interest. And interest is interest. And bank, whatever you pay, this will become interest. Now let me show the calculations here. You purchased 500 debentures at 95, come interest. So here I should do 500 into 95. 47,500. Then interest, if I calculate, balancing figure will become come interest. Interest I have to calculate. What is interest? Interest accrued till 1/4/2022. But from when? From previous date of interest payment. From when? From previous date of interest payment. Okay. Now, what is the previous date of interest payment? They pay 2 times a year, June 30, December 31st, half. So before April, which comes? Before April, 31st of December. So 31st of December till 1st of April. What is the time gap? 3 months, right? Jan, Feb, March. Face value 100. So 500 debentures, face value 100 each, rate of interest 10%, number of months 3 months, from December till 1st of April, previous date of interest payment. So 500 into 100 into 10% into 3 by 12, that is 1,250. This is interest portion. And then the remaining is X interest, 47,400 minus 1,250, 46,250. Okay, this is own debentures. And what is the purpose of purchasing own debentures? It is for immediate cancellation. So this investment in own debenture, you're not going to keep it with yourself. You're going to cancel it. So you pass an entry, 10% debenture account. Debenture is a liability. Liability will have a credit balance. To close the credit balance, we'll debit it, debiting it. How much ever is your face value? So 500 debenture into 100, 50,000. And 2, whatever is the investment amount. Investment in own debentures, that is 46,250. Still balancing figure is there. That balancing figure, we call it as profit on cancellation, which may be transferred to P&L or may be called as capital reserve. So 50,000 minus 46,250, 3750, profit on cancellation. Now, instead of passing these 2 separate entries, you may pass one single entry also. That is also fine. That is because investment amount we are debiting and we are creating it. So sometimes what institute does, they pass one entry only. 10% debenture 50,000. Interest account debit 1,250. 2 bank 47,500. Then 2 profit cancellation 3,750. Invest debenture account debit 50,000. Then interest account debit 1,250. 2 bank 47,500. 2 profit cancellation 3,750. Sometimes they also calculate like this, direct entry. So now next day transaction is coming on 1st of October. So on 30th of June, company has to pay interest payment, right? Interest account debit to bank. Interest on debenture to bank. How much they will have now? They don't have 5,000 debentures. Out of 5,000, 500 debenture is already cancelled. So only on the balance, 5,000 debenture minus 500, face value 100 at the rate of 10%. And this is paid half yearly into 6 by 12. So 5,000 minus 500 into 100 into 10% into 6 by 12. So 22,500 is the amount of interest that they are going to pay. 22,500. Okay. Then second entry, say next transaction taking place. On 1st of October, the company purchased 6,000 debentures at X interest. So on 1st of October 22, I think this time I'll pass one entry only. Okay, let me not confuse you. I'll pass two entries. So investment in own debenture, then interest to bank. Now investment in own debenture, this is what is come interest or X interest. And interest is interest. And to bank is come interest. So in this situation, 600 debentures of 90 X interest. So 600 into 90, 54,000 X interest. So I'm writing in investment. And interest accrued for how many months? I'm purchasing 1st of October. What is previous interest payment? 30th of June. So July, August, September. 3 months. So 600 into 100 into 10% and for a period of 3 months. $1,500. So come interest to bank 55,500. Then cancellation. So that is 10% debentures to investment in own debenture. So 10% debentures, that is 600 into 100, 60,000. Investment in own debenture, 54,000. And balance amount to profit on cancellation. 6,000. And as I told you, instead of passing two separate entries, you can also pass one single entry. That is also absolutely fine. Then on 31st of March, final interest payment. How much you are going to pay? 31st March 23. Final interest payment. You were having 500 debentures, 5,000 debentures, out of which 500 debenture was cancelled. Again, 600 debenture was cancelled. On balance, face value 100, 10% for 6 months. So 5,000 minus 500 minus 600 into 100 into 10% for 6 months. So you end up paying 19,500 only to bank at the end of the year. So this is the transactions relating to debenture, investment in own debenture, cancellation, cum interest, and X interest. And finally, how the interest payment will take place when cancellation of debenture takes place. Cancellation of debenture is a way of redemption. If you pay less, you become profit. If you pay more, that becomes loss. Okay, so this is regarding debentures. Aspects of company accounts. In this chapter, I would like to cover broadly two things. One is employee stock option plan, ESOP, other buyback of shares. I'll also cover one problem on each of this. So what is the ESOP? ESOP is a scheme where company gives the option to employees to buy the shares. So employees can become shareholders. Sometimes the offer is given immediately. That's called as employee stock purchase plan. And sometimes they have to fulfill some conditions that's called as vesting period. So some terminologies to understand. So grant date of announcement of the ESOP scheme. Then vesting date, the date on which the conditions has to be fulfilled. Like employee has to work for 3 years. So when he completes 3-year period, he becomes eligible. That is called as vesting date. And once he becomes eligible, he is not forced to buy the shares. He has the option, but not forever. Time limit is there. That's called as exercise period. At what price he can buy? That's called as option price. And usually this option price will be below market value. So if market value is, let's say, 80 rupees, then option price or issue price will be 60 rupees. 20 rupees benefit will be there. Otherwise, why will employees buy here? They go to market and buy. They have given the benefit of 20 rupees. The discount of 20 rupees to the employees, an opportunity to become shareholders. So the 20 rupees, the benefit is given is the expense for the company. So the 20 rupees, the difference, you have to pass an entry, employee benefit expense account to share capital. Sometimes face value might be there. Let's say face value is 10 rupees. Then how much benefit company is actually receiving? 20 rupees company receiving in the form of bank, and balance 20 rupees they're receiving in the form of employee services. That is indirectly salary paid. So what is the journal entry you have to pass in the books of company? Bank account debit 60 rupees, money received. Employee benefit expense account debit 20 rupees, discount given. To share capital, face value 10, balancing 70 rupees, security premium. So effectively, the discount given will be recorded as a expense by the employer. Now, if the vesting period is more than 1 year, let's say 3 years, 4 years, this 20 rupees, the benefit is not recognized in 1 year, it is spread across many years. Let's say 20 divided by 5, if 5-year period, every year you recognize 4 rupees. And once it is completed, then you will pass an entry for issue of share capital. So in this context, let me take up one problem. Okay, so company has divided into shares of 10 each on 1st of April. It granted 10,000 employee stock option of 40 where the market price 130. So discount is 90. Options sold to be exercised between 15th March and 31st March. Employees exercise their option for 9,500 shares only. Remaining option lapsed. The company closed the books upon March 31st every year. Show journal entries. So what are things to be kept in mind? The difference between market price and issue price is the benefit to employees. And this benefit to employees is the cost to company, expense to company. Journal entry, we debit for money received. So bank account debit for how many shares we have received? 9,500 shares. 9,500 shares multiplied by how much money we received at 40 rupees. 9,500 into 40. Okay, let me do one thing. Let me write per share basis what is each means. Then I'll pass one overall journal entry. Okay, per share basis. What is going to be bank? Per share will be 40 rupees. That is the money received. Then employee benefit expense. How much benefit we are giving? Market price 130, option price 40. So 130 minus 40. 90 rupee is the benefit given. To equity share capital, this will be face value. Face value is 10 rupees. To security premium, balancing figure. So basically, this is 40 plus 90 minus 10. That is 120. That will be security premium. Then you have to multiply it by number of shares allotted. Number of shares is 9,500. So 9,500 multiplied by 40 rupees. 3,80,000. Then 9,500 multiplied by 90 rupees. 8,55,000. Then 9,500 into 10 rupees. 95,000. 9,500 into 120, 11,40,000. So plus 95 minus 3,80,000. Yeah, tallied. So simple, straightforward thing. ESOP is a benefit given to employees where they can buy the share at a price lower than market price. The price at which they can buy, bank account debit. Market price minus the issue price. Market price minus option price, the benefit. Employee benefit account debit. To share capital to face value. To security premium, balancing figure. If you should account for only to those shares which has been accepted by the employees, exercised by the employees. Now, if there is a grant date and vesting date, meaning vesting period, employees has to fulfill certain conditions, then this employee benefit expense will not be recognized in 1 year. This will be spread across whatever the number of years. And only when the benefit is completed, when vesting period is completed, then you pass the entry. So until then, you pass an entry, employee benefit expense to ESOP outstanding. ESOP outstanding will come in the balance sheet under reserves and surplus. And when the exercise takes place, actually when the exercise takes place, then you pass entry bank account, ESOP outstanding account, to share capital, to security premium. So this is a problem relating to the ESOP of shares. Explain the concept once more. I think I just explained. I hope you're able to get the context. So this is regarding ESOP. Primarily, the shares issued to the employees at a discount. It's also issue of shares in a way. Yes, you asked me to explain the concept, and I hope you're able to follow it. And yes, do ask these kind of questions in the chat. I'll try to address it. Okay, this is one type of problem. Another type of problem I would like to address is regarding buyback of shares. So regarding buyback, let us go to theory point quickly. Buyback of shares meaning it is against opposite of issue of shares. So when you issue the shares, bank money comes in to share capital. Now when you redeem, when you do buyback, bank you pay, the share capital will be debited. It is exactly like the investment in own debentures. You purchase the investments, you purchase your own debenture and cancel against the debenture. That's what is buyback also. As far as limitation is concerned, three main limitations are there. You cannot exceed 25% of share capital, face value of shares. You cannot exceed 25% of share capital plus reserve. And post buyback, the debt equity ratio, the ratio of debt owned by company cannot be more than two times of its share. So you cannot have higher debt. In maximum debt is 2:1. If you have 1 rupee equity net worth, 2 rupee debts can be there. But more importantly, there is one more important thing that will take place. That is, when you do buyback, let's say buyback happens at 40 rupees, 10 rupee is the face value, 30 rupee is the premium. So share capital comes down by 10 rupees. You're paying 30 rupees extra. So your reserves will come down by 30 rupees. Your bank balance comes down by 40 rupees. One more important point, when you do redemption of preference share capital or buyback of share, Companies Act put one more restriction telling, to the extent of face value of shares, listen to me, keep this carefully, to the extent of face value of shares, company has to transfer an amount from free reserves to an account called as Capital Redemption Reserve CRR, which can be issued later only for the purpose of bonus shares. One additional thing will come. Why it comes? To protect against outsider interest. Otherwise, the shareholders, when the company goes for a loss, they do buyback of shares and leave nothing for the outsider. So to stop this from happening, to give the priority to the outsider first. Anyway, why and all, you don't worry. When there is a buyback of shares, apart from regular entries, company has to pass an entry for transferring free reserve to CRR, an amount equal to face value of redemption, and this CRR can be used only for the purpose of issue of bonus shares. On this, let me take one quick problem. Okay, let me solve it here itself. Okay, the share capital of company consists of 1 lakh shares, equity shares of 10 each, and 25,000 preference shares of 100 each. Security premium shows balance of 40, general reserve 7 lakh. The company decides to buy back 20,000 shares of 12 each, pass journal entries. So what are the entries you're going to pass? First entry is for buyback payment, or we can say buyback due. You can say buyback due, and then buyback payment, and then the transfer to CRR. These are the broad journal entries that you have to pass. Now, buyback due. You are making a payment and the share capital will go down. So share capital account debit, equity share capital, you can be more specific. Equity share capital account debit to the extent of face value. So 20,000 shares, face value of 10 each, so 2 lakh. Share capital will have a credit balance. Since we are reducing, we are debiting it. Then premium on buyback, premium will adjust from security premium. How much premium? Buyback is at 12 rupees each. So 20,000 into 2 rupees. 12 rupee minus 10, 2 rupees. 40,000. And premium is having exactly 40,000. So I can debit securities premium. If 40,000 was not there in security premium, then I can make use of any other general reserve, P&L account like that. To bank, sorry, to equity shareholder or buyback due. To, I can say to equity shareholder, buyback due. Two lakh 40,000. Or you can just say buyback due account. Then you make a payment. So equity shareholder account debit the receiver. Equity shareholders 2,40,000. Then you make a payment. So bank amount will go out to bank 2,40,000. You transfer to CRR to the extent of face value. So you need 2 lakh. And general reserve of 7 lakh is there. So I can make use of general reserve. General reserve to CRR. So general reserve is a free reserve. CRR is not a free reserve. CRR can be used only for issue of bonus shares. So to the extent of face value, so that becomes 2 lakh. So this is what the journal entries regarding buyback to be passed. One straightforward example that we have taken. Okay, so this regarding buyback of shares. Okay, now comes the monster. Consolidated financial statements. Basically, consolidated financial statements is reporting of a group and not of individual entity. Holding company will be there, subsidiary company will be there, and we combine and we report it. That's called as consolidated financial statements. Usually people follow so many steps: date of purchase, purchase of holding, date, percentage of holding, goodwill calculation, pre-acquisition, post-acquisition reserve calculation, things like that. I follow one tabular format, which many students have appreciated. Let's follow this format for the given problem, and let's try to understand the overall concepts. Okay, so this is a full-fledged problem. Using this problem as the base, we will understand the concept of consolidated financial statements. Because no point in explaining the format, logic. With limited time, we will not be able to do everything. So taking the problem as the base, I will help you understand the structure of solving the problems. Let's read the question once. Along with reading, I'll explain. A Limited acquired 1,600 shares of 100 each on 1st of July. On December 31st, the summarized balance sheet of the two companies were given below. A Limited, B Limited. Share capital, reserve, P&L, overdraft, bills payable, creditors, building, machinery, investment, stock, debtors, receivable, cash. Reserve on 1/1/2011 was 1 lakh, and P&L of B Limited showed a credit balance of 30,000 on 1st of January, out of which a 10% dividend was paid on 1st of August. A Limited credited the dividend to P&L. The plant and machinery, which stood at 1,50,000 on 1st January, was considered as worth 1,80,000 on 1st of Jan. This figure is to be considered while consolidating the balance sheet. The rate of depreciation on machinery 10%. Prepare consolidated balance sheet on 31st December. First, you get the overall context, right? First, you get the overall context, right? Overall context, we have holding company, we have subsidiary company, we are going to mix, we are going to merge, we are going to consolidate. In this process, there will be a lot of mutual owings. For example, A Limited has to pay to B. For A Limited, it's a liability. For B Limited, it's an asset. So when you consolidate, they are same. So we cancel it. Asset also will reduce, liability also will reduce. Like that. You look at A Limited, they have investments. They have investments. Now, what does this investment represent? They represent the ownership of B Limited, ownership of subsidiary company, which is share capital and reserves and surplus. Now, when I mix both of these two, this investment is to be cancelled against reserves and surplus and share capital. This is the overall context, asset cancellation versus liability. But here, some percentage is not held by the company, so minority interest comes into picture. Some of the reserve were made before acquisition and after acquisition. So those kind of analysis comes. So very simple. While solving my problems, follow simple structure. I call it as statement for consolidation, or you can say working note for consolidation. Statement for consolidation. Where many things, what people follow in various steps, we will get in one working note. One is called as, first column is whatever the amount. A statement for consolidation. First column, particulars, of course, then I write the amount. Then I write the holding company share, which I write goodwill within brackets. Within brackets because if the answer is negative, then it is goodwill. Then consolidated reserves, which is consolidated reserves and surplus. And then we have minority interest, MI. Keep this percentage in hand readily available. Now, in this case, what is the percentage? A Limited acquired 1,600 shares. Out of B Limited, 2 lakh, 100 rupees each. So 2 lakh by 100. So I can say 2,000. So 1,600 divided by 2,000, or do some calculation here. 1,600 divided by 2,000, which is 80%, right? 0.8 into 100, you can do it. 80%. So holding company share is 80%. You can show within brackets. Consolidated reserve also holding company share. Outsider shares is 20% minority interest. Okay, this will be the format. We will start with subsidiary company heading first. We will do various adjustments and then I will go to holding company column. Subsidiary company, you have to take three major items. One is share capital, then P&L reserves. Reserves, P&L, both are there. So subsidiary company, we will need equity share capital. Okay, and then we need reserves. And reserves, I will divide this into two parts. Reserves pre-acquisition, reserve post-acquisition. I'll tell you how to calculate. Then you come to P&L, P&L pre-acquisition, and P&L post-acquisition. Once you get these things right, then adjustments what they give. Adjustment in this problem, you have things like dividend, which I write at the end. Then plant and machinery, where you get something called as revaluation of plant and machinery. And whenever revaluation comes, you'll also get depreciation. So these are the things required for subsidiary company. Let me complete it, then we'll go further. So subsidiary company share capital is 2 lakh. So 2 lakh, I'll write it here. Okay, percentage allocation will come to it. Reserves, how much is pre, how much is post? That I have to do one small analysis. Okay, reserves. Maybe I can just show it here. I call that analysis of profits, basically pre-post calculation. Analysis of profits of subsidiary. First, we'll talk about reserves. So you take reserve, how much is in the balance sheet of subsidiary? Reserves of B Limited is 1 lakh. And on 1/1/2011, it was also 1 lakh. Amazing. Reserve closing balance 1 lakh. And opening balance means on 1/1/2011, opening balance also 1 lakh. Then what is the during the year amount? During the year, if 1 lakh has to become 1 lakh, that means nothing is transferred, 0. So entire 1 lakh, I can say it is pre-acquisition. So I can go to the reserves and say pre-acquisition is 1 lakh. There is no post-acquisition. So entire closing balance is pre-acquisition. Like that, then I'll do for P&L. I take the amount from the balance sheet, how much reserve I have. P&L I have. P&L is 82,000. P&L closing balance 82,000. Then I compare how much is on 1/1/2011, meaning opening balance. Then how much during the year? During the current year. Okay. Looking at the information, P&L showed a balance of 30,000. So 30,000 is the opening balance. So how would you analyze normally? 30,000 becoming 82,000, I can say 52,000 is earned during the year. Okay, hold on your thoughts. Out of this 30,000, some amount was paid. Out of this, a dividend of 10% was paid. If you pay dividend, reserves will come down. So 10% is on share capital, 10% on 2 lakh. So minus dividend, 20,000. So balance is 10,000. So 10,000 became 82,000. So during the year, if I have to calculate 82,000 minus 10,000 is 72,000. Now this 10,000 is definitely before acquisition. Acquisition happened on which date? 1st of July, I think. This is before acquisition. Therefore, this profit is called as pre-acquisition profits. Now 72,000 during the current year, is it pre or post? During the year 2011. When did the acquisition took place? On 1st of July. So during the year you made 72,000, but how much up to 1st of July? After 1st of July, we'll divide in proportionate basis. So dividing it in proportionate basis, 6 months, 6 months. So up to 1st of July 2011, after 1st of July 2011. So you get Jan to June, so 6 months, 72,000 into 6 by 12, 36,000. This is up to 1st of July, up to date of acquisition. Before acquisition is called as pre, and after 1st of July, 72,000 into remaining 6 months, also 36,000. After 1st of July, after date of acquisition, therefore this is called as post. Okay, now, so how much is pre-post? So total pre is 10 plus 36, 46,000. And here total post is 36,000. And total you can verify 46 plus 36, that is our total 82,000. So pre-acquisition is 46,000, post-acquisition is 36,000. So pre-acquisition 46,000, post-acquisition 36,000. Okay. Then revaluation of plant and machinery. That also, okay, I'll do it in a separate slide. Explain once more. Can you be more specific? Because calculation is there in front of you. Which amount you are not able to understand? Which calculation or which element? Please be more specific. Kind request. Pre and post acquisition. The date of acquisition is 1st of July. Any profits made up to that date is pre-acquisition. Any profit made after that date is post-acquisition. In the given situation, our closing balance is 82,000. Our closing balance includes all our profits made in the current year as well as in the earlier years. In the given problem, opening balance of 30,000 is given. Out of 30,000, they pay dividend. When you pay dividend, reserves will come down. So 10,000 is coming from opening balance. What was done in the previous year, earlier years. So profit made earlier year is pre-acquisition profits 10,000. Current year, if 10,000 opening should become 82, that means current year we should have made 72,000. And 72,000 is full year profit. When did the acquisition took place? 1st of July, middle of the month. So up to middle of the year. Up to 1st of July is before acquisition, is pre-profit. After 1st of July, after acquisition, post-acquisition profit. So opening balance is pre-acquisition. Current year first 6 months is pre-acquisition. And current year last 6 months is post-acquisition. And next year onwards, whatever comes is post-acquisition. I hope you understood. Opening balance of 10,000 is pre. Current year for 6 months is 36,000 is pre. So 10 plus 36, 46,000 is pre. And last 6 months of the year, that is after acquisition, that is post. Okay, great. Now, regarding revaluation, of machinery. Okay, revaluation machinery, keep it very simple. You have one column for subsidiary books. One column for group books, meaning consolidated purpose. Group means consolidation, then difference. So here one special thing is taking place. If you observe, they have given plant and machinery 1,50,000 is worth 1,80,000. So 30,000 more revaluation profit. But one problem is there. The dates are not same. 1,50,000 is on 1st of January, but revaluation on 1st of July, 6 months gap. So I cannot say 1,50,000 and 1,80,000. So what should I do? I have to bring from 1st of Jan to the 1st of July for 6 months. How do I make it comparable? I have to provide depreciation. That's why depreciation rate 10%. And depreciation is always per annum basis. So what we are going to write? As on 1/1/2011, as per subsidiary books, 1,50,000 minus depreciation for 6 months. So 1,50,000 into 10% for 6 months. So you get 7,500. So as on 6 months over 1/7/2011, it is 1,42,500. This is valued at 1,80,000. So the difference, you get 37,500, and this 37,500 is revaluation profit. And one more important point, this is as on 1/4/7/2011. If you value the asset higher, subsequently depreciation also will be higher. So minus depreciation for 6 months from July to December. This will remain same, 7,500. But here you have to calculate, that is 1,80,000 into 10% into 6/12. Think you get 9,000. The difference I don't require, but 7,500, 9,000. This difference, 1,500, is additional depreciation, incremental depreciation. So what do we need for working the consolidation purpose? These two numbers. How much is revaluation profit and how much is additional depreciation, incremental depreciation. And whenever revaluation profit is there, I get depreciation as minus, because if the value of the asset increase, subsequently my depreciation also will be high for that reason. So 37,500 is revaluation of profit. And remember, 37,500 is the pre-acquisition. It's a profit on the date of acquisition on 1st of July. So pre-acquisition. Depreciation is after 1st of July. So depreciation is post. And this one, I'll write within brackets 1,500. So once I get all these amounts, then I will divide 80/20. If it is pre-acquisition, it comes in goodwill column and MI column always. So if it is pre-acquisition, it will come in goodwill column, percentage of holding company. If it is post-acquisition, then it will come in consolidated reserves. So 2 lakh 80%, 1,60,000, and the MI 40,000, 80%, 20%. 1 lakh 80%, so 80,000 and 20,000. And then P&L pre 46,000, 80%. 36,800 and 20%, 9,200. Post acquisition, so it will come here, be careful. Post acquisition comes in consolidated reserves, 36,000 into 80%, 28,800. And this MI is as usual, 7,200, 20%. Pre-acquisition, 37,500, 80%, 30,000 pre-acquisition. Then 7,500 comes in MI. 1,500 minus number, so 80%. So 1,200 in consolidated reserves. MI is balance 300. Okay, so this is with respect to subsidiary companies line items. Now we'll come to holding company line items. Holding company, we will have holding company major amount is investments. Investment in subsidiary. And investment in subsidiary, I'm going to subtract, because all the amounts like share capital reserve were on liability side. Investment is asset side. So subtract. Investments 3,40,000. And holding companies reserves P&L will come, entirely will come in consolidated reserves. Holding companies reserves, this is within brackets, huh? 3,40,000 investments show within brackets. So reserves and P&L. Holding company reserves 2,40,000, P&L 57,200. 2,40,000, 57,200. 2,40,000, 57,200. Entire amount will come in reserves. 2,40,000, 57,200. And there is one more treatment that we should do. That is with respect to dividend received by holding company. Now, dividend is an income, but dividend out of pre-acquisition profits is not to be taken to P&L, it is to be taken to investments. Why? That I don't want to discuss at this point in time. It's beyond our scope. Let's focus on how. Let's not worry about why. Take a look at this information. It showed that is out. Dividend of 10% was paid on 1st of August. A Limited credited the dividend received to P&L. If it was pre-acquisition dividend, then to be taken to P&L. If it is post-acquisition dividend, sorry, if it is post-acquisition dividend, holding company should take it to P&L. If it is pre-acquisition, it should be taken to investment. But they have wrongly taken that to P&L. That should be eliminated. And why it is pre-acquisition profit? Because what is the source of dividend? Source of dividend is the profit on 1/1/2011. So profit on 1/1/2011 is pre-acquisition. See, we have done the calculation also here. 20,000 is subtracted from 30,000 pre-acquisition. So it is a pre-acquisition dividend wrongly credited to P&L account, needs to be rectified. So what rectification we do? We'll take out from P&L, means we'll take out from reserve column and we'll put it back to goodwill column. So pre-acquisition dividend wrongly credited to P&L. Pre-acquisition dividend wrongly credited to P&L. What is the amount? Dividend was calculated 20,000, right? 20,000. But enter 20 is not holding company. Holding company share is 80%. So 20,000 into 80%, 16,000. We subtract from P&L, means consolidated reserves, and we take it to goodwill, means we take it to investment. So this is what is the working notes required. And after this, it's simply about preparation of balance sheet. Okay, let's do the total. How much we get? 1,60,000, 80, 36,800, 30 minus 3,40,000 plus 16,000. So hope you're getting negative number 17,200 in our column. If it is negative, that is goodwill. If it is positive number in our method, that is capital reserve. 28,800 minus 1,200 plus 2,40,000 plus 57,200 minus 16,000. 3,08,800. NMI 40,000 plus 20 plus 60,000 plus 9,200 plus 7,200 plus 7,500 minus 300. 83,600. Okay, this is a working note. We still have to prepare the balance sheets. Okay. Now let me prepare consolidated balance sheets. Consolidated balance sheet. Okay. So broadly two sides, that schedule 3 format. In a way, we are also revising schedule 3 format. Equity and liabilities. First, I will have shareholders funds. Under that, we'll have share capital and reserves. So when you say share capital, we will write only holding company. Holding company A Limited 5 lakh. Then coming to reserves. Reserves as per the statement, working note. Right? Statement or the working note, which we have done the calculation here, 3,08,800. Then one new thing will come. Minority interest, again as per the statement, 83,600. Then non-current liabilities. I'll use short form, hope you understand. Do we have any long-term liabilities? Nothing, no long-term liabilities. Then current liabilities. Current liabilities, we have overdrafts and bills payable creditors. So overdraft, I'll show it as short-term borrowings. Short-term borrowings, which is overdraft, 80,000. And bank overdraft, trade payables. Trade payable, we have bills payable 8,400 plus creditors 47,100 plus 9,000. So 64,500. Okay, total. Then we can come to asset side. Assets, we have non-current assets. Under that, we have, we don't call it as fixed assets, we use the word PP, property, plant, equipment, which we had land and building and plant and machinery. So land and building is concerned, 1,50,000 plus 1,80,000. This was land and building. Plant and machinery, 2,40,000 plus 1,35,000. And the adjustment what we made, revaluation and depreciation. Revaluation 37,500, depreciation 1,500. So plus 37,500 minus 1,500. So 1,50,000 plus 1,80,000 plus 2,40,000 plus 1,35,000 minus 37,500. Sorry, plus 37,500 minus 1,500. Think 6,66,000. Then intangible assets, goodwill. Intangible, which is goodwill, as per the statement, 17,200. Then current assets. I told you how to remember current assets, ITC. Inventories, trade receivables, cash and cash equivalents. Inventories means stock. Trade receivables, cash and cash equivalents. So inventory stock 1,20,000 and 36,400. So 1,56,400. Trade receivables and bill receivable. So 44 plus 40. Plus bill receivable of 15,800. So 44 plus 40 plus 15,800. 99,800. And cash equivalents. 14,500, 8,000. 14,500, 8,000, 22,500. Total, I hope balance sheet tallies. Let's check it out. So 5 lakh plus 3 lakh 8,800 plus 83,600 plus 80,000 plus 64,500, 10 lakh 36,900, 6 lakh 66,000 plus 17,200 plus 1 lakh 56,400 plus 99,800 plus 22,500. What is the small difference? Why it is not tallied? Okay, give me 1 second. Check again. Any error is there? 6,66,000 plus 17,200 plus 1,56,400 plus 99,800 plus 22,500. 75,000. Any difference? I think we have taken everything correctly. Okay, just give me 1 second. If you are able to find any mistake, let me know why anything that we missed. The question tallied, I did not check it. That the question in the problem, everything is tallied. TP is 7,41,000. Was it my calculation mistake? 1,50,000, 1,80,000 plus 2,40,000 plus 1,35,000 plus 37,500 minus 1,500. Oh yeah, 7,41,000. Yeah, correct. 7,41,000. Yeah, thank you. I think now it's fine. 10,36,900. Yeah, non-current assets. I hope the PP, I hope I have corrected it. Okay, this is one full-fledged problem on consolidation. I think solving this, you'll be able to get, hope, a better idea. Okay, great. So this is on the discussion on consolidated financial statements. Next, we'll go to the next concept, which is on financial statement analysis, or ratio analysis, as we would say. So ratio analysis, so many formulas are there. I'll try to divide this into logical format, logical structure. So broadly, there are, I would say, 5 areas, to be specific, 4. Ratio, liquidity, that is in the short-term short-term solvency, profitability analysis, capital structure, that is mix of debt and equity, and operating performance or efficiency ratios. Liquidity ratio, 2 ratio, current ratio, quick ratio, current assets by current liabilities. Quick ratio, liquid assets by current liabilities. Liquid assets means excluding inventory. From current assets, we subtract inventory. What I get is called as liquid assets. Then profitability margin, like a gross profit ratio, gross profit by sales into 100. Net profit ratio, net profit by sales into 100. Important one, return on equity, ROE, and ROC, return on capital employed. Return on equity, for equity shareholders, what is the return? Net profit, profit after tax, divided by what does equity shareholders own? What does it belong to them? Net worth. Net worth means share capital plus reserves. Simply we call as equity. So PAT by equity is return on equity. Return on capital employed means we take the debt as well as equity. So EBIT divided by capital employed. Capital employed means debt plus equity. That's called as return on capital employed. Capital structure theory ratio, that is mix of debt and equity. The most important one, I would say, debt equity ratio and interest coverage ratio. Debt equity ratio, debt by equity. Interest coverage ratio, what you cover with is profits. So EBIT divided by interest is interest coverage ratio. Operating performance, efficiency, all are turnover ratios. So numerator, you can keep it as turnover, simplest. So if the ratio is asset turnover ratio, numerator sales, denominator assets. Fixed asset turnover ratio, numerator sales, denominator fixed assets. Working capital turnover ratio, numerator sales, denominator working capital. Debtors turnover ratio, sales by debtors. Inventory turnover ratio, sales by inventory. Or some people say not sales, but cost of sales or cost of goods sold divided by inventory. So all performance ratios talk about performance of the efficiency or resource utilization. That is what is called as efficiency ratios, numerator, turnover, denominator, respective assets. Valuation ratios, most important them is P ratio, market price per share divided by earnings per share. Higher the P ratio represents higher the confidence. People are paying more for every 1 rupee profits, MPS by EPS, market price per share by earnings per share. In details, under each of these ratio, what does it mean I have given? If you're worried about whether higher ratio better, lower ratio better, One simplest thing I would say, in general, higher the ratio, the better it is, except two D's. One D, when you express in days, other D is debt. Debt, loan is risky, though higher, not good. Days, collection period, inventory holding period, payable days. When you express in days, it is lower the better. So keeping these in mind, let's take one problem to get certain formulas into consideration. Okay, your X company has made plans for next year. It's estimated the company will employ total assets of 8 lakh. 50% of assets is by borrowed capital at 8% per year. The direct costs are estimated to be 4 lakh 80 and other operating expense to be 80. Goods to be sold to customer, 150% of direct cost, tax rate 50%. You're required to calculate net profit margin, return on assets, and asset turnover. And one more thing also I forgot. I think it did not come here. You can add one more ROE, return on equity. And there's also one more, which I never thought they will ask in exam, in your exam, but they asked. That's called as DuPont analysis. So that also let me solve it for you using this problem, DuPont analysis. So let me solve this question. So first thing what you need to understand is have the capital structure ready. The assets, capital structure, assets employed, capital employed, asset structure or capital employed. Total is 8 lakh. And this, you divide this into two parts. 50% of assets by borrowed capital. So 50% is loan. Debt, I can say 50% is borrowed capital, debt. Balance 50% is equity. So 8 lakh 50% is 4 lakh. And 8 lakh 50% is 4 lakh. Oh, then we'll go do the income statement. In financial management or when decision making happens, we will follow this income statement structure. We'll start with sales. We subtract variable cost. In this problem, we have direct cost. So sales minus direct cost, what we get is contribution, or we call it as gross profit. Like in trading P&L account, trading account, you get gross profit. Minus indirect cost, what you get is EBIT, before interest. Interest also is there. EBIT. And from EBIT, we subtract interest. What we get is EBT, earning before tax. Then we subtract tax. Ultimately, what we get is profit after tax. And that's what we also call it as net income or net profit. So in this case, how much is sales? Sales they have not given. Goods will be sold at 150% of direct cost. And the direct cost is 4,80,000. So 4,80,000, 150% multiply. It is sold at 150% of direct cost. So that is 7,20,000. Direct cost 4,80,000. So gross profits 2,40,000. Indirect cost, other operating expense 80,000. So you get EBIT of 1,60,000. Negative number I can show in brackets. Interest loan is 4 lakh. and the rate of interest is interest cost of 8%. So 4 lakh into 8%, 32,000. So 1,60,000 minus 32, 1,28,000. Tax 50%. 50% tax, so 64,000. So net profit 64,000. Oh, then ratios what they've asked for. First ratio, net profit margin. That is net profit by sales into 100. Net profit means that PAT 64,000 divided by sales 7,20,000 into 100. 64,000 by 7,20,000 into 100, 8.88%, or I can say 8.89%. Then return on assets. Some people do return on assets based on net profit, and some people do based on EBIT, operating profit. So I will calculate based on operating profit. Operating profit means EBIT. And sometimes they calculate based on net profit. In that case, formula will be PAT. So based on operating profit, EBIT divided by capital employed, assets, capital employed. Into 100, which is EBIT of 1,60,000, capital employed of 8 lakh into 100, 20%. In fact, it's also called as ROCE, return on capital employed, is 20%. When I calculate based on operating profit, that's called as ROCE. Then asset turnover ratio. Assets turnover ratio, sales by assets. So for every 1 rupee assets, how much sales we could generate? Sales is 7,20,000. Assets is 8 lakh. 7,20,000 by 8 lakh, 0.9. Some people have this confusion. When this percentage will be there and when do we write times? In this case, asset turnover ratio, I'm writing as times, net profit margin, I'm writing in percentage. Very simple. Whenever it is multiplied by 100, it is percentage. If I don't multiply it by 100, it becomes number of times. So fourth one. ROE, return on equity. That is profit after tax divided by equity into 100. This is what actual shareholder is earning at the end of the day. PAT is 64,000. Equity 4 lakh into 100. That is 8%. Okay. Now, one additional analysis I'm going to do is a DuPont analysis. Other one also I'm going to do relationship between ROCE and ROE. That also I will discuss using the same data points. Okay. Now first I'll do DuPont analysis. DuPont analysis basically breaks down the ROE into separate components. So what is the formula for ROE? Overall formula, what we have, profit after tax divided by equity. Right? Equity is what shareholder puts in money. Profit is what he gets. Starting point of a business, ending point of a business. But in between, there are a lot of other elements to be understood and observed, which are, they will say, PAT divided by sales, you do it. Then you do sales divided by assets. Then you do assets divided by equity. So mathematically, if you observe, sales and sales cancelled, assets and assets cancelled, you get PAT by equity only. But you get elements. So PAT by sales will tell you the net profit margin, profitability indicator. Sales by assets will tell you assets turnover ratio. So this will tell you the efficiency of the organization in converting the assets into sales, ability to use the resource. Efficiency is reflected in this ratio. Then assets by equity. This is called as the multiplier, equity debt multiplier or leverage multiplier. Leverage multiplier. So with my equity, my own funds, how much assets I'm able to deploy. If I take more debt, that means multiplier is high. I'm taking external higher help. So if I analyze this, what is the PAT by sales? Net profit margin, 8.89%. And what is sales by assets? Turnover ratio, 0.9 times. What is assets by equity? Assets is 8 lakh and my own equity is 4 lakh. So if you calculate here also, I should get the same answer, net profit margin of ROE of around 8%, rounding it off. So DuPont analysis break down ROE into individual components. So essentially, how business flow works in practical life. Any business you start with capital, which we call it as equity, and you may take more loan, right? You take additional loan, take debt, that will give you capital employed, or you get assets. Like for example, your own money 50 lakh, you take a loan of 50 lakh, you buy asset worth 1 crore. Okay. Now, once you have the assets, using the machinery, you'll produce goods and you make sales. And from the sales to the customer, you collect money from them. I mean, you make expenses, you manufacture, so you will have profit. That's the process, right? Ultimately, equity to profit, this is ROE. Then from sales to profit, this is net profit margin. From assets to sales, assets turnover ratio. And from capital equity to capital employed, that is the leverage impact, leverage multiplier. The whole structure of the business divided into small components using the respective ratios, that is DuPont analysis. Okay, there is one more analysis, connection between ROCE and ROE. Let me discuss that. Relationship between ROCE and ROE. Now, what is ROCE? Return on capital employed. This is from business point of view. ROE is from owner point of view. How do we differentiate? If I take a loan of 40 lakhs, I put in my own money 60 lakh, I buy a house worth 1 crore. The house is business. But how much money I have put in? 60 lakhs. That is my money. For 60 lakhs, how much I return is ROE. For 1 crore house, how much rental income it gets? That is ROCE. So in the given situation, there's also a formula to explain. ROE is given as how much ever ROCE plus ROCE minus interest multiplied by debt by equity. That will be a multiplier. And of course, if you want after tax, then you multiply it by 1 minus tax rate. So when you generate interest or when you generate ROCE to taking the debt, simple example, you take a loan of 100 rupees, you pay interest of 8 rupees, but using 100, you generate 10 rupees. You pay 10, you generate 10, you pay 8, generating 10, paying 8, 2 rupee will be pocket for equity shareholders, ROC minus interest. Whereas if you generate only 6 rupees, still you have to pay 8 rupees, 2 rupee will be taken out from the equity shareholders pocket. That's the beauty of ROC and ROE, benefit of debt on equity shareholders. Basically, we say if ROC is greater than interest rate, okay. If ROC is greater than interest rate, debt is good. Taking loan is good. If ROC is lesser than interest rate, debt is not good. So in the given example, ROCE, that is ROA based on operating profit, 20%, plus ROCE, 20 minus 8. We have taken a debt of 4 lakh, equity also of 4 lakh, overall multiplied by 1 minus tax rate, 1 minus 0.5. Tax rate is 50%. So 20 plus 20 minus 8 is 12. 4 lakh by 4 lakh is 1. So 20 plus 12 into 1 minus 0.5 is 0.5. So 32 into 0.5, you'll get as 16%. I hope that's what we got here also. ROC, sorry. ROE was 8%. Oh, sorry. 20 minus 8 as 12. What's happened? ROC was 20. Rate of interest 8%. 20 minus 12, 8 is 12. Oh, that was 16%, I think. 64,000 divided by 4 lakh. Oh, sorry. I think I correct 16%, right? So not 8%. Should have told me. Nobody told me this thing. The answer was 16%. 64,000 by 4 lakh is 16%. Thank God I did the additional analysis. Otherwise, everybody would take it as 8. If I do a mistake, tell me no. 64,000 by 4 lakh, 16%. Here also, I think I will not get 8. I should get 16%. Let me check. 8.89 into 0.9 into 8 lakh by 4. I think you get 16%. And here also you got 16%. I think 16% is ROE. If I'm doing a mistake, please do tell me. That means I think you're not calculating. Anyway, marathon session. So time is less, I understand. Okay, so this is one analysis of DuPont analysis, ratio calculation interpretation, and also relationship between ROE and ROCE. I tried to cover the maximum with the help of one problem. Okay, so we have done with this relationship between ROC and ROE. Very good. Then financial statement analysis, basically ratio analysis. Oh, next is cash flow statements. Cash flow statement is one of the financial statements after balance sheet P&L account. A cash flow statement divides the activities into three kinds. Operating activities, normal course of business, like collecting money from debtors, paying rent, paying salary, normal course of activities. For investing activities relating to the application of funds, asset side of balance sheet, purchase of machinery, purchase of building, interest income, interest from investment, investment is sold, relating to the asset side, investing activities. Relating to financing activities means liability side, source of funds, loan taken, loan repaid, shares issued, buyback, dividend paid, interest paid. Anything relating to the liability side of balance sheet is called as financing activities. So during the year, how much cash we generated from our business, how much cash we got from our asset side, how much cash from liability side, put together that net cash flow during the year, we add the opening balance, we get the closing balance. This is the cash flow structure. And cash flow, we have two methods. One is direct method, indirect method. In fact, that is only applicable for operating activities. As far as financing and investing, it's only direct. But in operating activities, we have direct method or indirect method. So direct method means very simple. How much receipts minus payments. Cash from sale of goods, cash from debtors, cash from sales, minus payment for various expenses, receipts minus payments, cash flow from ordinary activities, cash flow from operating activities. Whereas indirect method is complicated, is challenging. We start with profit after tax. Then we add non-cash items like depreciation. We add non-operating like interest cost. What we get is, we start with profit after tax, add back tax. Tax provision we add back. So we get net profit before extraordinary items. Then we do adjustment towards working capital. What is working capital? If inventory increase, if debtors increase, if creditors increase, what will happen to our cash balance? If inventory increases, cash balance reduce. It is like purchase of inventory. If debtors reduce, the cash balance increase because that is like collecting money from debtors. Current creditors increase. It is like taking loan, so cash balance increase. To remember like this, if current assets increases, cash will reduce. One asset increase, other asset reduce. Current liability increases, cash increases. One liability increase, other liability also has to increase. Okay, keeping this in mind, let's prepare one cash flow statement. I think this also you have taken from your institute question only. Anyway, does not matter. First, let's try to understand each differences. What is the meaning? Share capital 30,000 becoming 40,000. Increase in share capital means issue of shares. And issue of shares should come in cash flow from financing activities. Shares related to financing element, liability side. Now, preference share capital 15,000, 10,000. Preference share capital reduced means share capital would have been redeemed. Now, general reserve 4,000 to 7,000. How will reserve will increase? Must have been transferred during the current year. That is current year profits. P&L account 3,000 becoming 4,800. Why will P&L increase? You must have made profit during the current year, increase in profits. Proposed dividend. Dividend, you have to be careful. Previous year proposed dividend will be paid in the current year, and current year dividend will be outstanding at the end of the year. So 4,200 is financing activity because previous year proposed dividend is paid in current year. Paid will come in financing activities. Whereas 5,000, which is current year proposed dividend, which is yet to be paid, or we need a profit after tax, for this we will add to get the operating activities. Increase in creditors, working capital impact. Bills payable decrease, working capital impact. Provision for taxation, current again previous year tax would have been paid during current year. So at the starting of operating activities, I add back current year profit. So I get profit before tax. And in last line, I will do minus tax, I get profit after tax. Goodwill decreased means written off. Building reduced means depreciation. Plant increased means purchase. Debtors increase, working capital change. Stock increase, that is working capital impact. Bill receivable increase, working capital impact. Cash in hand, cash at bank, we'll take it in the cash flow from the opening cash and closing balance of cash. Oh, depreciation of 2,000 on land and the building 1,000 has been charged. Depreciation of 2,000 on land and building and 1,000 on plants. If 20,000 is building, becoming 17, you wrote off only 2,000, then what happens to balance 1,000? Maybe other write-offs. Interim dividend also paid. So from current year profit, you have to add. Income tax 3,500 has been paid. Maybe we have to prepare one provision for taxation to understand how much income tax has been paid. Prepare cash flow for 2022. So I'll take the institute solution example only, and I'll give the explanation for each calculation, how it comes. Or let me calculate. I think calculation is more comfortable. Let me calculate. Okay. So if I do cash flow from operating activities as structure, so first we calculate cash flow from operating. And then we'll do cash flow from investing and then financing. First starting point for us is profit after tax. But we don't have profit after tax. So what I'm going to do, I will calculate increase in reserves and increase in P&L. Because the current year profit must have been this. And then I do plus current year proposed dividend. Then I add interim dividend, proposed dividend, current year, CY, interim dividend. This will give me my current year profit after tax. Why I'm showing you this calculation? Because In some problem, they might give you P&L directly. P&L means you directly get PAT. So increase in reserves. 4,000 becoming 3,000. So 4,000 becoming 7,000. So 3,000 is reserves. P&L 3 becoming 4,800. So 1,800. Proposed dividend, current year proposed dividend. Proposed dividend current year only 5,000. And interim dividend paid during the year, interim dividend of 2,000. So this is your current year profit after tax if I calculate at this point in time. Then plus how much is current year tax provision? Tax provision current year. Normally we will take previous year tax 4,000 as paid during current year. And the current year 5,000 is current year provision. But how much they have paid? 3,500. So out of 4,000, they have paid only 3,500, which means balance 500 is actually in the current year. So how much current year provision? 5,000 minus 500. You can say 4,500. Or if you want to prepare, you prepare one tax provision ledger where you are going to write opening balance as by balance brought down, opening, and closing balance as to balance carried down, closing. And when you make a payment, you say to bank. And current year provision, you write it as by P&L account, balancing figure. So if I calculate here, opening balance of provision for tax was 4,000. Closing balance is 5,000. Current year tax payment, they have given information 3,500. So if we calculate this as balancing figure, 8,500 minus 4,000. So you get 4,500. So the tax provision for current year is 4,500. Institute just show calculation directly, 3,500 plus 5,000 minus 4,000. Logically, if I tell you, previous year provision in the balance sheet was 4,000. You paid only 3,500. So balance 500 is still not paid. So in the closing balance of 5,000, if 500 is still not paid, how much is current year provision? 4,500. If you don't want too much of confusion, you can simply write this tax provision ledger. So what you get at this stage is basically profit before tax. Then I do adjustments for all non-cash items. So I'll add depreciation. What are depreciation I have? And in write-off will be adding. Asset said, goodwill written off, 11,500 becoming 9,000, 2,500 plus goodwill write-off, 2,500 plus depreciation, all non-cash. Depreciation, they'll give information. Land and building, 2,000. Depreciation on land and building, 2,000. And depreciation on plants, 1,000. Okay. Any other non-cash? I think that's all the non-cash. Then coming to income tax, interim dividend, this may be considered. Okay. Then I come to working capital changes. Working capital changes. One by one. Debtors 16 became 20. Debtors increase means you should reduce cash. Increase in current assets, decrease in cash. Current assets, current liability, opposite. Current assets increase, cash decrease. So increase in debtors 4,000. Increase in debtors 4,000 within brackets. Increase means minus. Then stock also increased, also minus. Increase in stock. 10,900 minus 3,700, 3,200. Then debtor stock or bill receivable also increase. So again minus. Increase in bill receivables. 2,000 becoming 3,000, 1,000. Cash on hand will come separately. Coming to liability side, don't take proposed dividend, don't take provision for tax, only two things. Creditors, bills payable. Creditors increase means plus. Increase in creditors. Which is 5,500 becoming 8,300. That is 3,000, no, 8,300 minus 5,500. 2,800. Think 2,800. If I just check it. 8,300 minus 5,500. Yeah, 2,800. Bills payable, 2 becoming 1,600. Bills payable reduced. 2,000 becoming 1,600. Bills payable reduced, so it will be minus. So decrease in bills payable. 400. 1,000 becoming 2,000 becoming 1,600. Then tax paid during the year 3,500. So less tax paid. So please observe, to get the profit before tax, the tax provision for current year is added and tax paid will be subtracted in the last line. Similarly, we will do for dividend also, okay? Whatever dividend we added back as provision will pay, but not here in financing activities. So taxes paid 3,500. So this amount will give you cash flow from operating activities. So 3,000, 1,800, 5,000, 2,000, 4,500, 2,500, 2,000, 1,000, 4,000, 3,200, 1,000, minus 400, minus 3,500. I think you get 12,500. This is cash flow from operating activities. So since operating activity is only more complicated, hope you're able to follow it. Now, once we are done with the operating activities, now it is straightforward to do investing and financing. Let's do part B, investing activities. Cash flow from investing activities. So investing means related to asset sides. So goodwill written off, non-cash, we already taken in operating activities. Building, please observe, 20,000 has become 17,000 And depreciation of 2,000 they have given. So 20 minus 2, it should become 18,000. How come it is 17,000? That means you should have sold some plant. If no information is given, it is assumed to be sold at cost, no profit, no loss. So 20,000 minus 17 minus 2, 1,000 is the selling price. If it is sold at, let's say, 100 rupees, you will write 1,100, but that 100 has to be subtracted in operating activities, which should have taken to P&L account. We should eliminate if there was any profit. Anyway, in this case, nothing. So, sale of building, sale of landed building, 20,000 minus 2,000. It should have been 18,000, but closing balance 17. So balance is 1,000. It is assumed to be sold at cost. That is no profit, no loss. If there was any profit information, loss information, I should take it in operating activities. If it is profit, I subtract. Loss means I add. Okay, this is regarding landed building. Plant has been 1,000. Oh, plant, you look at it. 8,000 was opening, closing 20,000 must have been purchased in spite of depreciation of 1,000. So 8,000 minus 1,000, it should have been 7,000. If 7 becoming 20, that means you should have purchased 13,000. Or you can calculate like this. Purchase of plant. Something like this you can do. Closing minus opening plus depreciation. You can also prepare the ledger account by balance, to balance brought down, by balance carried down like that. So closing balance of plant 20 minus opening balance of plant is 8. And the current year depreciation is 1,000. So 20 minus 8, 12, 12 plus 1, 13. 13,000 I show within brackets. The reason is it's purchase. There's no interest income. So I can say net cash flow from operating activities, outflow of 12,000. This is cash flow from investing activities. Then cash flow from financing activities. Liability side of balance sheet primarily. If I look at the equity share capital, 30 became 40. Issue of equity shares, 30 to 40, 10,000. Issue of equity shares. 10,000. Positive. Preferential capital reduced, so minus. Redemption of preference shares. $5,000 minus. General reserve will not come, PL will not come. Dividend, previous year dividend 4,200. Dividend paid. Previous year dividend paid. Dividend paid. Previous year. Previous dividend paid in current year. Or as a dividend paid related to previous year. 4,200. And current year dividend, interim dividend paid. Interim dividend paid. Interim dividend paid 2,000. Anything else? Creditors, bills payable, for tax. I think that's all. Yeah, this will become your cash flow from financing activities. So 10,000 minus 5,000 plus 4. Sorry, this also is paid minus. This also paid minus. So 10,000 minus 5 minus 4,200 minus 2,000. So 1,200 is cash flow from financing activities. Yeah, 1,200 cash flow from financing activities. Then when you add all the three, you get net cash flow during the year. Net cash flow during the year, which is A plus B plus C. 12,500 minus 12,500 minus 1,000 minus negative 700. For this, you add opening cash. What was the opening cash? If I take the balance sheet, 1,500 and thousands. So opening cash, 1,500 plus 1,000. So 2,500. This will give you the closing cash. So 2,000 minus 700, 1,800. Does it match? 1,000 plus 800. Cash in hand and cash in bank. 1,000 plus 800. 1,800. Okay, so this is cash flow statement. More importantly, indirect method, because that method is very easy. Receipts minus payments, that is cash flow from operating activities on operating items like collection from debtors, payment of rent, salary, etc. Indirect method is more challenging, where you start from profit after tax, you add back tax, add back depreciation, and if you take it as increase in reserves, then you should add back dividend also, and then working capital changes. That's the way in which you get indirect method of cash flow from operating activities. One small trick I can say, overall cash flow statement you understood, right? How to do it. You will start with cash flow from operating activities, cash flow from investing activities, cash flow from financing. Then you get the net cash flow. You add the opening balance, and that's when you get the closing balance. Now, this is the structure of cash flow statement, and this closing balance should be tallying with the balance sheet. You do one thing, closing balance, you write, like in this example, we already know in the balance sheet, the closing balance should be 1,800. Opening balance will be given in the problem, 2,500. You work backwards, 2,800 minus 2,500 is 700 within brackets. Now, among the three, which one is complicated? Is it operating, investing, or financing? Where is it? The mistake can happen most probably, mostly in operating activities. So investing, financing, you write it. Investing 12,000 within brackets. Financing 1,200 within brackets. You compute operating activities like a balancing figure. Work backwards means you add. So you have minus 700. For this minus 700, you do plus 1,200 and you do plus 12,000. So minus 700 plus 1200 plus 12,000. You will get 12,500 operating activities, which is what we would have supposed to get by calculating so many numbers. But don't try directly cash flow from operating activities in the exam and leave it like that. Valuator will easily come to know. So to satisfy his mind, you also write profit as per P&L or increase in reserve plus depreciation, changes in working capital. You write and make it look like you're getting 12,500. Satisfying the validator mind is also important because validator will not have the time to calculate all these things and then say 12,500. He will look at the calculations, look at the number. If the number is correct, he'll give you a number. He will not take calculator and calculate. Okay. And let me tell you one more thing. This answer is correct. This method is correct, provided your investing activities and financing activities are correct. If that is wrong, then operating activities cash flow also will be wrong. All the shortcuts are subject to conceptual risk. Please understand the concept before applying the shortcuts in exam. If something goes wrong, I am not responsible. I have told you the concept, I told you the shortcut. Disclaimer. All mutual funds are subject to market risk. Please read the cover document carefully before investing, like that. Anyway, use this technique to verify your answer from the operating activity so that you get the approximate answer instead of breaking your head where things would have gone wrong. Anyway, I thought of sharing this. I hope it somewhat is useful. Okay, so this is regarding cash flow statement. One last chapter in accounts, that is forecasting of financial statements. Basically projection of financial statements on various methods. You can do on ratios, you can do on time series analysis, like that. One typical problem you can expect in exam, something like this. I take the institute question only. Let me read and let me explain you the concept. And I'll take you the institute solution only instead of copying it down. You are a company secretary of DP Limited and assign the task of profitability projections of different scenarios on historical data provided, revenue, variable cost, fixed cost, depreciation, tax, cash flow from operation, net cash flow. Companies forecasting the sales will be increased by 37.5% approximately. Sales will increase. When sales increases, we have two types of costs. Usually, variable cost also will increase, but fixed cost will not increase. That is the nature of fixed cost. When the volume increase, if you produce more goods, the variable cost also will be there. If it is a textile company, you produce more shirts, you should consume more cloth. So when sales increases, variable cost increase is variable cost. Fixed cost will not increase. That's why it's called as fixed cost. If you increase your sales, you produce more t-shirts, your accountant salary will not increase. Your office rent will not increase. Things like that. Keeping in mind, whereas variable cost will be forecasted 56% of sales, companies in anticipation of fixed cost of 15 crore. On the other side, worst situation, companies forecasting the sales will curb by 25%, or sales can also be down by 25%. Keeping in mind market force, where the variable cost will be forecasted 65% of sales. Or if it is when the sales up by 37.5%, variable cost is 56% of sales. It varies. If it is down, then variable cost is 65% of sales. Company's anticipation of 25 crore. In that case, 25 crore. It is forecasted depreciation remain changed in both the cases at 28.57%. You're required to calculate the profitability difference by projecting between the two. I'll show you the institute solution. So this was the problem. Let's now take it down. Let me explain the concepts. So you see, sales historically 200, we got 200. Two columnar, it will increase by 37.5 plus 37.5. It will decrease by 25% in the second situation, minus 25%. Sales is taken care. Now coming to variable cost. Variable cost is 120, that is given at the present situation. In the second situation, variable cost is 56% of sales. You can see 56% of sales. So 56% of 275, you get 154. Similarly, if it is down, then it is 65% of sales, 65% of 150, and that is 97.5. Sales minus variable cost, 200 minus 120, 80. 275 minus 154, 121. 150 minus 97.5, 52.5. Sales minus variable cost contribution. Fixed cost, at present fixed cost is 20. And if it is market is up, fixed cost they said 15.15 crore. And if it is down, they said it is 25 crore. So 15 crore, 25 crore. Depreciation remains same at 28.57 percentage. So if you calculate tax rate 58.5%, depreciation remains same. Depreciation 25. So 25, 25, 25 as given in the problem, depreciation remaining same. So contribution minus fixed cost, 80 minus 20 minus 25. 121 minus 15 minus 25. 52.5 minus 25 minus 25, you get EBIT. No interest. No information on interest. This also is EBT. Tax at 28.57 percentage. So 35 into 28.57, you get 10. 83, 28.57. It is correct only, no? 35 minus 10. And then 2.5 to 28.57, you get 0.71, you get profit after tax. Yeah, the increase 25 can become 57 or 25 can become 1.79 crores. So that is what the analysis of profits in case of forecasting financial statements if the sales is up or if the sales is down. So I took the institute solution only just for understanding purposes. Hope you're able to follow it. Okay, so that is actually completion of corporate accounting part of it. And then we have to do financial statements. I think before that we can take a break for lunch. 1:30 now. I think let's make that 2:15. Okay, let's resume for financial management at 2:15. And then, of course, we are going until maybe 4:45, 5 o'clock. Until then, we are going to complete it. Okay, so that's the plan. Let's resume at 2:15. Okay, welcome back, my dear friends. Hope you had sufficient food, not a great food because you know 2 a.m. or 2 p.m. it's a good time for sleeping, but I hope you will be not falling into that. So we have done with the corporate accounting summary discussion. Now we'll move towards financial management. From exam point of view, which one is more complex to crack, FM or corporate accounting? I cannot choose one. FM has got an advantage and disadvantage. It's a new subject advantage. Disadvantage is there are no steps like in accounts, there are steps, but you should know some basics to cover it up. So I would recommend try to solve the institute study material questions. Basic hours, you go to exam hall, sufficient. Let's look at the financial management. Let me make use of my material. So first chapter in financial management is a theory one. So briefly, we'll go through it. Financial management is actually concerned with two primary aspects, and that is on source of funds and application of funds. And they're also called as two main functions of financial management. Procurement of funds, where the money is obtained from. It can be from various things such as equity shares, debenture, venture capital, like that. Equity share means advantage. There is no obligation to pay interest like debt, no obligation to repay like debt, but there is voting rights, which is dilution of ownership. Debenture, the advantage, disadvantage of equity shares are opposite. Venture capital is also a way of equity shares only, where a set of people called as venture capital who fund your ideas. Their philosophy is very simple. I come up with financial capital, you come with your intellectual capital, you run the business and you increase the value of business and give me a share in it. Venture capitalist in a modern day world where bank don't give for traditional forms, the venture capital will come and support the new age thinking, the new age business. Applications, or we can also call it as decisions, investment decision, financing decisions, dividend decisions. Investment decisions is regarding where to put the money. Broadly, we have the subject on capital budgeting and working capital management. These two about if you have the money, how to make use of it, where to invest. And then financing decisions, we have topics such as cost of capital, cap structure, about the liability side, financing side. And the main objective, one of the theory question you can expect in exam, objective of financial management is wealth maximization and not profit maximization. I know that profit is the ultimate motive of business, but one has to think beyond the profit, that is to generate wealth for shareholder. So financial management is the subject regarding decision making. Before thing happens, you have to think in advance what could happen. And that's why this chapter, this subject is important. Decisions regarding investment, where to put the money, decision regarding financing, where to take the money from, and decision regarding dividends about distribution of profits. And while taking these decisions, one has to ensure the shareholder wealth is given the utmost importance. The shareholder's wealth means shareholder's funds. You can say share price, which is long-term in nature, whereas profit is short-term in nature. Whereas profit does not consider risk because it's short-term in nature, whereas wealth considers all types of risk while making decisions. So ultimately, what is good for shareholder, what benefits the share value, that should be the guiding factor for taking decisions in these three areas. And finance is called as the lifeblood of business, and therefore it has connected with all other disciplines like production regarding purchases, creditors, purchase departments, personnel, HR, sales, everywhere the financial management play a significant role. Summary on this chapter, it's a pure theory chapter. In your study material, they have given a lot of questions, something like IRR, return on investment and all. But when you read the first chapter, you will not be able to make the returns calculation. When you go further to other chapters, you will be able to make it. So even if you want to read the institute study material on first chapter, read only this much theory. You do other chapters, then come back and do first chapter. You'll be able to understand many concepts given in the study material in a better manner. Second chapter, time value of money. Basically, concept of time value of money is rupee 1 today is different from rupee 1 tomorrow. As the time progress, the value of money changes. So today 10,000 and after 1 year 10,000, it's not equal. Its purchasing power is different. Its value is different. And as a compensation for the loss in time value of money, an amount paid is called as interest. We have two types of interest, simple interest and compound interest. But as far as examination, financial management is concerned, even practical life is concerned, we typically apply compound interest. So compound interest, the formula goes with this: F equals P into 1 plus I power N. That 1 plus I representing for every 1 rupee invested plus I. 1 plus I becomes future value. And you keep multiplying by 1 plus I, you keep getting the future value. That's called as compounding. And if you want present value, the present value will be future value divided by 1 plus I to the power of n. That is called as discounting. And in fact, 1 by 1 plus I power n is also called as discounting factor. A very important terminology, especially when you go to chapter like capital budgeting. Investment decisions, capital budgeting, discounting factor, which converts future value to present value, is an important factor. Then we have a series of payments. They are called as annuities. Let me quickly give you some formulas for annuities also. So regarding time value of money, if it is a one-time payments, then future value is given by present value into 1 plus I to the power of n. And present value is given as future value divided by 1 plus I, or actually it's also written as 1 by 1 plus I power n. And this is called as discounting factor. And in fact, there can be situations such as compounding done more than once a year, compounding done half yearly, like that. In that case, the frequency of compounding is applied. If it is compounding done quarterly, rate of interest is divided by 4 and n multiplied by 4. If it is compounding done half yearly, I divide by 2 and the power n multiplied by 2. If it is compounding done monthly, I divide by 12 and the power I multiplied by 12. The frequency of compounding, rate of interest divided, and number of years is multiplied. And if it is equal payments, that is series of payments, which is called as annuities, like in case of life insurance premium, LIC, you pay, you get maturity at the end. Or housing loan, you take loan now and you repay over a period of time. So series of payments, future value is given by annuity into A into 1 plus I power n minus 1 divided by I. This is called as future value of annuities, applicable like in LIC, sinking fund. And similarly, present value of annuities. Present value of annuities given by same formula, A into 1 plus I to the power of n minus 1 divided by I whole into 1 plus I power n. Or the better structure what we follow is present values given by annuity multiplied by annuity factor. And what is annuity factor? It is sum of discounting factor. Every year you calculate discounting factor. When you multiply the annuity, that is present value. In solving problems, we use this more than the formula approach. So what is the main difference between discounting factor and annuity factor? In fact, both does the same job. Annuity factor and discounting factor, when you multiply, it converts the future terms, future amount into present value amount. It converts future value into present value. But what's the difference? Discounting factor converts one-time cash flow into present value, whereas annuity factor converts a series of payments into present value. This is an important concept as far as capital budgeting chapter is concerned. Keep it in mind carefully. So let's take a sample problem on this concept. So this is the question. A company offers fixed deposit scheme whereby 10,000 matures to 12,625 after 2 years on a half-yearly compounding basis. If company wishes to amend the scheme by compounding every quarter, what will be the revised maturity value? So you have to understand, first of all, is this a problem on compound interest or is this a problem of annuities? Annuities comes only when there are series of payments like installments, monthly saving, yearly saving, things like that, there will be annuities. In this problem, when you put 10,000 today, it becomes 12,625. So one-time payment, one-time receipt, it's based on uh, not based on annuities, it's based on regular compound interest formula. And it is half yearly compounding. So the formula you have to divide by 2, that formula amendment, you have to keep it in mind. So future value equals present value into 1 plus I to the power of n. Because half yearly compounding, I divide by 2 and in the power n, I multiplied by 2. 10,000 become 12,625. So 10,000 is today value, present value, and 12,625 after 2 years. Therefore, it becomes future value n number of years, that is 2 years. And you have to find out the rate of interest. So let me simplify this. So 12,625 equals 10,000 into 1 plus rate of interest divided by 2 to the power of n2 multiplied by 2. So 10,000 goes to left side. So 12,625 divided by 10,000, 1.2625, and here 1 plus I by 2 to the power of 4. And mathematically, how do you take the 4? Take square root, fourth root both sides, 1 by 4 both sides. And when I do 1 by 4, that will become to the power of 1 by 4, and this also to the power of 1 by 4. I have to do both sides. So when I do 1 by 4 both sides, 4 and 4 gets cancelled. So what remains is 1 plus I by 2 equals 1.2625 to the power of 1 by 4. How to calculate to the power of 1 by 4 in calculator? Press the square root 2 times. Square root 2 times, you get your number. So 1.2625 square root, you get 1.06. So 1 plus I by 2 is 1.06. 1 goes to right side. So I by 2 equals 1.06 minus 1. And therefore I by 2 equals 0.06, or I equals 0.06 into 2, basically 0.12 or 12% you can say. Now what we have to do, if the same formula is applied, we have to calculate the revised maturity value if it is compounded on quarterly basis, not on half-yearly basis. So I'll use the formula again. Future value equal present value into 1 plus I just calculated, divided by 4, quarterly basis, divide by 4 to the power of n multiplied by 4. Whatever you divide, you multiply. Present value is 10,000 into 1 plus rate of interest, we just calculated 0.12, divided by 4, power n is 2 multiplied by 4. So basically you get 8. So 10,000 into 1.03 to the power of 8. So how do we calculate 1.03 to the power of 8? You can do 1.03 into equals 7 times. Whatever the power, you press equal to 1 time less. So 1.03 into 1, 2, 3, 4, 5, 6, 7. I think you get 1.2667. 1.2667 or oh yeah, 1.2668. I think I can say 1.2668. So you get 10,000 into 1.2668. So multiplied by 10,000, you get 12,000s. 1.2668 into 10,000. 12,668. Yeah. So rounding it off, you can say 12,670. That is the revised maturity value. Revised maturity value. So this is on basic concept of time value of money using the future value and present value and compounding done more than once a year. To be kept in mind in calculator side, when we want to do 1.03 to the power of 8, I do 1.03 into equals 7 times. 8 years minus 1, so 7 times. If I'm calculating discounting factor, that will be 1 divided by 1.03. Discounting factor, don't do minus 1 and all. Do same number of years. Keep it in mind regarding discounting factor. So if I want discounting factor at 12% for 7 years, what will I do? Or let's say 3 years. 1 by 1.12, that is 1 by 1 plus I, equals. You should press 3 times only in denominator. I get discounting factor whenever I recover discounting factor. If I need annuity factor, then all these discounting factors should be added. So I press something called as GT, grand total. All discounting factor gets added. Sum of discounting factor is called as annuity factor, which will be used in our capital budgeting problems like NPV calculations. Okay, let's go further. Okay, next topic. On capital budgeting. Again, heavy topics, many formulas are given in one place. I try my level best to cover the aspects. Capital budgeting relating to investment decisions. Basically, investment decision is about long-term projects such as machinery should be purchased. Nowadays, we talk about AI, artificial intelligence. So in our business, should we replace or introduce AI? Things like that. Heavy investment is required and long-term in nature, so complex decision. So to analyze from financial management point of view, some techniques are there. We have broadly two varieties. One is called as traditional methods, and then we have time-adjusted methods. Traditional methods, something like payback period or accounting rate of return ARR, does not take into account time value of money into consideration. And when you consider time, that is time-adjusted method, there we have mainly three formulas. More also there, mainly three: NPV, net present value, IRR, internal rate of return, profitability index, PI, where time value of money is considered. Payback period, it is the time taken to recover your investment. So formula wise, it is investment divided by annual cash flow. If you invest 10 lakh, every year if you get 2 lakh, 2 lakh, 2 lakh, 2 lakh. How many years required? 10 lakh by 2 lakh, you need 5 years. Investment by annual cash flow. So one thing, it's important, please keep it in mind. Cash flow is different from profit. Cash flow is profit after tax plus depreciation. Depreciation is non-cash in nature. But to arrive at the profit, depreciation is also an expense to be subtracted. Because depreciation is non-cash, that is added back. And for many of this formula, cash flow is what is considered in financial management. So cash flow is one. Then we have ARR, accounting rate of return. It is percentage terms for the investment we made, how much return we get. So numerator in profit, profit means PAT. So denominator investment, return on investment into 100. And some people don't take investment. Many times institute, in fact, don't take investment into consideration. They take average investment. Average investment is opening investment plus closing investment by 2. So if machinery purchase price is 1 lakh today, after 5 years, it becomes 20,000 salvage value. Average investment is 1 lakh plus 20,000 divided by 2. You can either calculate based on ARR, average investment basis, or you can calculate based on initial investment basis. Answer will be different, but that is fine. Give a note in the exam. So this is regarding ARR, accounting rate of return. Then comes the most important one, NPV, net present value. So what is the net present value concept is? So every year, let's say year 1, year 2, year 3, you get cash flows, right? Cash flow of year 1, cash flow of year 2, cash flow of year 3. And what is the total cash flow? I cannot simply sum like 10,000, 10,000, 10,000. I cannot say 30,000 because of time value of money. So I bring all these cash flows into today value. What I get is called as present value of cash inflows. And how do I get the present value of cash inflows? The cash flow I multiplied by respective discounting factor. For cash flow 1, discounting factor 1 is multiplied. For cash flow 2, discounting factor of second year is multiplied. For cash flow 3, discounting factor of third year is multiplied. Like this, what I get is present value of cash inflows. Then minus investment, initial investment, today investment, in cash inflows is inflow, investment is outflow, and investment is anyway in present value terms. So when I calculate this net amount, so present value cash flows minus investment, that becomes NPV, net present value. So net present value is present value of inflows minus initial investment, and project is accepted when NPV is greater than 0. Why NPV greater than 0 is accepted? When NPV is reached, it means our target is reached. See, in our calculation here, the discounting factor, discounting rate is the cost of capital, expected rate of return. So in a project, I'm expecting 12% rate of return. If I'm getting more than 12%, I'm happy. That is NPV. NPV representing more than what is expected. If you expect 18%, you may not get what you're getting. NPV will be negative. In that case, project is not accepted. So when NPV is more than 0, project is accepted. Between the multiple projects, whichever NPV is highest, that one is selected. So NPV formula, present value of inflows minus investment. Or presentation wise, it's also can be presented like this. Year cash flow multiplied by discounting factor, last column discounted cash flow. Year 1, 2, 3, 4, 5. Cash flow, respective cash flows. Discounting factor, respective discounting factors. When I multiply, I get DCF. And when I do the last column total, I get present value of cash inflows. And if every year cash flow is equal, instead of using discounting factors, I can make use of annuity factor. When every year cash flow is same, then how do you calculate present value of cash inflows? Annual cash flow multiplied by annuity factor. That will give you present value of cash inflows. So that is NPV. Then IRR, it is the rate at which NPV equals to 0. I just now told you what is NPV. If I expect some return, am I getting that return or not? If NPV is more than 0, that means my expectation is crossed. Now, if I change my expectation, instead of 12%, I expect 13%, NPV will change. So every time an investor changes his expectation, NPV will undergo a change, and so the decision might undergo a change. Instead of recalculating NPV every time, why don't we calculate that rate itself? That rate is called as IRR. IRR is the rate at which NPV equals to 0. It is the rate at which present value of inflows is equal to investment. It is the rate of return provided by the instrument. NPV is calculated from investor point of view. IRR is calculated from investment point of view, from the project point of view, irrespective of the investor. IRR is greater than cost of capital, the project is accepted. What is profitability index? It is in ratio terms. So NPV was rupee terms, IRR was percentage terms, profitability index is in ratio terms. So for every 1 rupee invested, how much we get back? Present value of inflows divided by investment, PV of inflows by investment. So this is useful when we want to compare across many projects. It's called as capital rationing, portfolio of projects. So when we have amount and we have to allocate among many projects, we should know which project is most profitable. So for every 1 rupee invested, how much we get? We go by profitability index ranking. We calculate PI for every project. Whichever project has got the highest PI will get the first rank. Next highest PI, second rank. And in the order of the ranking, our capital also will be allocated. Then the amount of investment will be given first preference to first rank, remaining amount to second rank, remaining amount to third rank. We keep allocating the funds in the order of ranking. That's called as capital rationing. Profitability index is used for that purpose. Okay. Then we have risk-adjusted techniques. Problems I'm going to have only on NPV calculation. Problem in the institute material only I've chosen. But before that, there are some risk-adjusted techniques. So every time you observe, people only look at return. They don't look at the risk associated with the returns. So we say we should always take calculated risk in life. But many people don't know how to calculate risk. This method will tell you how to incorporate risk in evaluation of projects. We have methods like risk-adjusted discounting rate, RADR. So what do? A project which is having higher risk, we discount with higher rate, discounting rate. The expected rate of return will be higher. So a project having higher risk is given higher discounting rate, risk-adjusted discounting rate. Then we have CE approach, certainty equivalent approach, where we multiply every year cash flow by a certainty equivalent factor, something like, let's say, 0.9, which means my cash flow, if I'm expecting 1 rupee, 0.9, I'm very confident, balance, I'm not very clear. I'm certain about 0.9 in every 1 rupee I project. So if you are certain about 0.9, take only that number. Don't take what is not certain. That is certainty equivalent approach. Every year cash flow is multiplied by certainty equivalent factor. You get certain cash flow, and certain cash flow you can multiply by discounting factor. You get present value, subtract investment, you get NPV. Regular approach. Sensitivity analysis. You know what you mean by sensitivity? When one variable changes, other variable reacts. The response is called as sensitivity. So in market also, if news comes that RBI is going to increase the interest rates, some stocks respond differently, some other stock respond differently. Take you for example, if a mobile phone falls down, how sensitive we are. If a friend falls down, how sensitive we are. Mobile falls, your heart is falling. Your friend is falling, nothing is falling. That's a moment of enjoyment for you, entertainment for you. For different things, we react differently. Same way in project, if sales changes, NPV change. If cash flow changes, NPV will change. If number of units sold will change, NPV will change. So when one variable change, how much NPV will change by, we calculate. That is called as scenario analysis. Simulation analysis is based on the certain statistical techniques. We simulate so many trials and then we try to calculate maybe an average based on that. A decision tree based on probability approach primarily. Like in year 1, probability is 0.5. Year 2, probability is 0.4. Then both of their probability becomes 0.5 to 0.4. So we calculate something called as joint probability, then multiplied by the cash flows. That will give you the expected NPV, expected cash flows. If an NPV is more than 0, the project is accepted. So many methods are there. Of course, we have our limitations to cover, but briefly, I tried to cover all the aspects. One problem from the institute material, I will take it. Okay, let's take up this question. SK Limited is considering purchase of new machine, which will come out on some operations which are present performed by labor X and Y alternative models. The following informations are available: cost of the machine, estimated life, scrap value, estimated cost of indirect materials, estimated saving of direct wages, additional cost of maintenance, additional cost of supervision. Depreciation will be charged on straight line basis. A tax rate of 50% is assumed. Calculate the payback period. Unadjusted return on average investment method. Net present value method. Cost of capital 8%. Note PV factors also given. So PBP is there, unadjusted NPV index. So two things are in the traditional method, payback period and ARR. And two we have in time adjusted method, NPV and PI. IRR is not applicable, but IRR also briefly I'll tell you how to calculate and what is the formula behind it. So for you to calculate NPV or PI or anything, we need something called as cash flow. And because so many information will be there, I divide the problem into 3 categories called as initial cash flow, interim cash flow, and terminal cash flow, IIT. Initial, interim, terminal. Initial cash flow is the initial cash flow in the sense when you want to start like machinery purchase, machinery cost becomes initial cash flow. And when machinery life is over, at the end, what you will have? Salvage value. That becomes terminal cash flow. And during the machinery period is alive, where you can produce goods and make profits, that is called as interim cash flow. So when too many informations are there in the exam problems, to do it in a structured, logical manner, make use of this analogy. Initial cash flow, when the project is started. Interim cash flow, when the project is running. Terminal cash flow, when the project is over, like machinery salvage value. Now, in this case, cost of the machine comes first. So initial, Now, estimated life, cost, and saving, saving in scrap, no, direct wages. Okay, so using the life of the machine, we can calculate depreciation. Now, saving in scrap, cost of direct materials, cost maintenance, all these are your annual cash flows, interim cash flows. These are interim. Any salvage value is there? I think no salvage value. Zero salvage value, nothing is there, zero salvage value. That will take it as terminal cash flow. Or sometimes there might be working capital. Initially, the working capital is considered as investment. And when the project is over, working capital is released. That becomes recovery of working capital, part of terminal cash flow. Okay, so first we'll calculate annual cash flow, annual profit also required, because for return investment we need PAT also. So calculation of annual profits and annual cash flow. Usually we have to start from sales. Machine A, machine B, two machine we have. We'll have to start from sales. But in this problem, sales is not there. Instead of saving, instead of sales, they have given saving in scrap per annum and saving in direct wages. So the saving becomes our sales. Normally, I should take it as sales. But sometimes, because of purchasing the machine, our expense can go down. That is our benefit. Sales or savings in cost. In this case, we have savings in cost. I'll just add both of it together. Scrap 1,000 and direct wages 9,000. So 1,000 plus 9,000, 10,000. And here 1,500 and 12,000. So 13,500. Okay, this is savings in cost less all expenses. What are the expenses we have? Indirect materials 600, 800. Indirect materials 600, 800. Maintenance 700, 1,100. Maintenance 700, 1,100. Then we have supervision. That is also a cost. Supervision cost 1,200, 1,600. And then depreciation also to be taken into consideration. Now, depreciation formula is cost of machine minus scrap value or salvage value. Cost minus scrap value divided by number of years, useful life. So in this case, cost of the machine 15,000, no salvage value given. So directly I can do 15,000 divided by 5, I can do it. Minus 0 divided by 5, no salvage value. So you get 3,000. Then 24,000 and 4 years. So 24,000 minus 0 divided by 6 years, sorry, divided by 6 years. You get 4,000. So this will give you the cost. 600, 700, 1,200, 3,000, 5,500 is the cost. 800 plus 1,100 plus 1,600 plus 4,000. 7,500 is the cost. So we have sales or savings minus cost. So now I can calculate something called as profit before tax. So this, if I call it as A, and this total cost, if I call it as B, if this is A, and this is something as B, then profit before tax is benefits minus cost. So 10,000 minus 5,500, you get 4,500. And the 13,500 minus 7,500, you get 6,000. Okay, you got profit before tax. You have to pay tax minus tax. I think tax at the rate of 50%, which is 2,250 here and 3,000 here. So what remains is profit after tax, 2,250 and 3,000. So we got profit after tax. I need cash flow. For cash flow, I add back depreciation, no, which is non-cash, plus depreciation, which is 3,000 and 4,000. So what I get is called as annual cash flow after tax, 5,250 and 7,000. Okay, let's go for measures calculation. Let's do traditional method, which is payback period and an ARR. So we have for again to measure machine X and Y, not AB. Machine X and machine Y. So machine X, machine Y. Two methods are there. First is payback period, which is formula is investment, initial investment, divided by annual cash flow. Then we have ARR, accounting rate of return, which is profit after tax divided by, they said average investment. They said calculate based on average investment. And how do you calculate average investment? Opening plus closing divided by 2. And what is opening? Opening is the purchase price. And closing is the salvage value. In this problem, there is no salvage value, so 0. So for the first machine, investment is 15 and cash flow, we got it as 5250. So 15,000 minus 5250. So divided by 5250. 2.857. Let's say 2.86 years. And for machine Y, 24,000 divided by cash flow 7,000. 24,000 divided by 7,000. So 24 by 7, you get 3.42, or let's say 3.43. So if I have to make a decision based on this, which one I will choose, whichever machine is giving me faster recovery. So 2.86 here, this is faster. So if I have to choose one, based on this, I'll choose machine X. Now coming to profit after tax for machine X, PAT 2250 divided by average investment. Average investment, opening 15,000, closing 0, no salvage value, divided by 2 into 100. So 2250 divided by 7,500. 30%. And here if I have to do, PAT is 3,000 divided by average investment, 24,000 plus 0 divided by 2 into 100. So 3,000 divided by 12,000 into 100, 25%. So here again, if I had to choose one, then higher rate, higher return is in machine X. So these are the two things which is applicable for traditional methods. Now I'll go to the time adjusted methods. Time adjusted means again machine X, machine Y. Two methods we are going to do. One is NPV and other is profitability index. NPV, how do we calculate? Present value of inflows minus investment. And how do we get profitability index? Present value of inflows divided by investment. One is in rupee, other is in ratio terms. And how do you get present value of inflows? Whatever is your annual cash flow after tax multiplied by annuity factor. Why annuity factor? Because every year cash flow is same. If every year cash flow is not same, then I have to multiply it by discounting factor respectively. So in the first case, what is my annual cash flow? 5250 is annual cash flow into annuity factor that they have given 8% for 5 years. This project is 5 years, is 3.993. 3.993 minus investment of 15,000 purchase price. So 5250 into 3.993 is 20,963 minus investment of 15,000. 5963. If I do for project Y, annual cash flow is 7,000 multiplied by annuity factor for 6 years. That's also given 4.623 minus purchase price of 24,000. So 7,000 into 4.623, 32,361 minus 24,000. You get NPV of 8,361. So if you choose NPV, the highest NPV is Y. If I go with profitability index, present value inflows by investment. So inflows is 20,963. What I calculate here? By investment, 15,000. 1.3975. And here, present value of inflows, 32,361 divided by 24,000. 1.3484. So higher one, again 1.39. So this is higher. Okay, so this is what is NPV, profitability index. One more is there IRR, at which NPV should become 0. So what should I do is, I'll assume a higher rate so that NPV becomes negative. So I have one rate NPV positive, one rate NPV negative. Then I use something called as interpolation formula. IRR equals lower rate plus difference in rate by difference in NPV into NPV at lower rate. So by doing this, you can get the percentage at which NPV is 0. Okay, so again, I try to cover maximum concepts in a summary format. Okay, let's go further. Okay, so the next chapter is cost of capital. The meaning of cost of capital is from the company point of view, for every source of funds, they have to pay a price for it. Nothing is free. If company is raising some funds, there is a cost associated with that. And if I know the cost, that will help me to evaluate the project. Like NPV, I need cost of capital. I need discounting rate. That depends on this cost of capital chapter. So cost of capital basically means for every 1 rupee raising capital, how much cost you're incurring. If it is something like cost of debt, where you're talking about debenture as a source, interest you're going to pay. If you talk about preference shares, you're going to pay preference share dividend. Equity is a challenging one because paying equity dividend is not the obligation for the company. So as far as the cost of debt is concerned, if it is irredeemable debt, the formula goes like this. Interest cost numerator divided by net proceeds into 1 minus t because we want to convert into after tax. All our profits, cash flows are after tax. So interest also I need, cost also I need after tax. So after tax means I multiplied by 1 minus tax rate. Net proceeds is the net amount received and available for investment purpose. So whatever the amount raised minus issue expenses. So this is like whatever the capital amount raised minus issue expenses. So in case of debenture, there'll be something like underwriting charges, stamp duty charges. If it is loan, bank loan processing charges. So how much net amount the company receives, that should be in the denominator. And formula wise, don't by heart. What is the name of the chapter? Cost of capital. Cost numerator, capital denominator. Cost, interest into 1 minus t, capital, net proceeds. This is really irredeemable debt. Irredeemable debt means the maturity period is not known. Now, redeemable debt, then the redemption value also is important. The formula goes like this. Interest into 1 minus tax rate. This part is same as numerator plus RV minus NP. RV stands for redeemable value. And NP, just like what we discussed, net proceeds. Divide by N, remaining time to maturity. So for example, if I receive 1 lakh and if I'm redeeming 1,10,000, 10,000 is also my cost. Spread across number of years, divide by N. Denominator is like my average investment. Like I told you, right? ARR, average investment, opening plus closing by 2. Opening, today value, NP, net proceeds. Closing value, redeemable value, RV. Opening plus closing divided by 2. It's like average investment. So this is cost of debt. Now, as far as cost of preference share is concerned, it is same as cost of debt. Cost of preference share, it is same. Except one thing. What is that? 1 minus T don't apply. Because in case of debenture interest on loan, it is an expense as far as taxation is concerned. But dividend is considered as distribution of profit, no tax benefit for the company. So 1 minus T is not applied. 1 minus T don't apply. So same formula. Instead of interest, I write preferential dividend. 1 minus T will not come. In case of this also redeemable preference share, the into 1 minus T will not come. Otherwise, the formula is same. As far as cost of equity is concerned, is a challenge because in companies not having any outflow of cash obligation like interest or preference share dividend. So we take the indirect route here, we take the implicit route here. What implicit route? What shareholder expects is my cost. Shareholder is the owner of the company. I'm receiving money from him. His expectation is company's cost. Shareholders' expected rate of return, opportunity cost of capital is the cost of equity for the company. So different models are there. Two popular models are dividend growth model. The shareholder is expecting dividend. D1, dividend at the end of the year. D1, dividend at end of the year. Dividend expected. Dividend expected at end of year. 1. G, that is anyway growth rate. P0, the price today, market price today. Again, concept wise same. Numerator cost, denominator capital, cost of capital, D1, dividend, the company is likely to pay. P0, what shareholder is giving the company, price. And any issue expenses I have to subtract to get the net proceeds. And this is, and growth also expect as a shareholder. I'm not satisfied with only getting a constant dividend. I expect a higher rate. That's why it's growth rate. Now, one more important one is CAP model, capital asset pricing model, Nobel winning award model. Simple one, but yet effective. RF stands for risk-free rate. Risk-free rate. B stand for beta. RM standing for market rate. So logic of this formula is very simple. When I invest, think like an equity shareholder point of view, I always expect minimum rate of return. If I keep my money in FD, if I keep my money in government bonds, I get minimum return of 8%. That is RF. Then if I keep the money in stock market, then I can get higher returns. That is market return. Market return is average market return, like Sensex return, Nifty return, index mutual fund, index return, average return, RM. But if I invest in particular stock, it's even more riskier. That is represented by beta. So for investing in the market, I should expect high return. You can call it as risk premium. And for investing in particular stock, that is represented by beta, beta representing a risk for a stock. If higher beta is there, higher risk, so I should expect higher returns. So based on the risk of a company, the expected return is set, and that is CAPM model. So using this, we get the cost of debt, cost of preference shares, cost of equity, and then we are going to calculate what is called as overall cost of capital, combining all of them. It's also called as average cost of capital because we calculate based on the weighted average, not a simple average. It's called as weighted average cost of capital. And how do we calculate the weight? Weight can be calculated on book value basis or market value basis. Book value means share capital divided by total capital. Share capital plus reserves plus equity plus debt plus preference shares. Or market value means number of shares multiplied by price per share. You get the amount divided by the total. We give you the weight based on market value basis. And you have the cost multiplied by the weight. You get the weighted cost. The total is called as cost of capital. And short forms, for debt, we say cost of debt. Cost of preference share, we say KP, cost of preference shares. Equity, cost of equity, KE. And overall cost of capital can be called as KO or also called as WACC, weighted average cost of capital. So this is the overview of this chapter. Now let us take a problem to understand about these formulas what we discussed. Let's take up this question. XYZ Limited has the following book value capital structure: equity share capital, preference share capital, retained earnings, debentures, term loan. The next expected dividend of equity share per share is 3.6. Dividend per share expected to be grow at 7%. Market price 40. Preferred stock redeemable at 10 years, currently selling at 75. Debentures redeemable after 6 years, currently selling at 80. Income tax rate 40%. Calculate the weighted average cost of capital using market value proportions. So first we have to calculate individually each element: cost of equity, cost of preference share, cost of debenture, cost of term loan, and then we calculate the overall cost of capital. As far as cost of equity is considered, we have dividend information and market price information. So dividend based model D1 by P0 plus growth rate can be used. For preference shares, we have preference share stock redeemable after 10 years, currently selling is given. And debentures also redeemable after 6 years. So I can make use of cost of debt, cost of equity, cost of preference shares. And retained earnings, cost of retained earning is equal to cost of equity because that also belongs to shareholders. But one more point to be kept in mind, because market value proportion we use. And when I say market value of equity shares, it includes the share capital as well as retained earnings. Put together is only market value. So again, cost of retained earnings, I will not take in overall cost of capital calculation. And term loan, that is a simple one, rate of interest multiplied by 1 minus tax rate. So we'll calculate one by one. First we'll calculate maybe preferreds. Okay, we'll calculate for equity capital. So cost of equity, KE, given by D1, dividend expected, by P0, current market price, plus growth rate. What is D1 in this case? Dividend expected is 3.6 and current market price is 40. So 3.6 divided by 40 plus growth rate of 7%. 7% means 0.07. So 3.6 by 40 plus 0.07, you get 0.16. KE 0.16, or if you multiply it by 100, you get 16%. Then we have cost of preference shares. What is the formula we can use cost of preference shares? Preference share dividend, don't do 1 minus T. It is redeemable, plus RV, redeemable value, minus net proceeds, divided by number of years, whole divided by redeemable value plus net proceeds divided by 2. What is preference share dividend? 11%. So 11 rupees per share. Plus redeemable value. Redeemable after 10 years. Currently selling at 75. When nothing is given. Redeemable at preference share face value. Face value is 100. So redeemable at 100. Currently selling at 75. So current selling price is the net proceeds. 100 minus 75 divided by after 10 years. So divided by 10 whole divided by 100 plus 75 divided by 2. So 11 plus 25 by 10 is 2.5 divided by 100 plus 75 divided by 2, 87.5. So 11 plus 2.5 divided by 87.5, 0.1543. Or if you multiply it by 100, 15.43%. Cost of equity, then cost of debt. Next is debt only, no? Or retained earnings. Okay, retained earnings is equal to cost of equity. So cost of retained earnings is equal to cost of equity. They are equal. Now cost of debt, I take interest into 1 minus T plus redeemable value minus net proceeds divided by N whole divided by redeemable value plus net proceeds divided by 2. Interest 13.5 into 1 minus tax rate somewhere here 40%, so 0.4 plus redeemable value, again currently selling at 80 and redeemable at par. We'll take it at par, so face value of 100. So 100 minus 80 divided by number of years is 6 whole divided by 100 plus 80 divided by 2. So 13.5 into 0.6, 8.1, 20 by 6, 3.33 divided by 90. Point 132526 or 13.26%. Last one, KT, cost of term loan. Term loan, no complication like this. Simply rate of interest you can multiply it by 1 minus tax rate. So rate of interest is 15% into 1 minus tax rate. So you get, I think, 9%. Okay, so once we now got the individual cost of capital, now we'll go for overall cost of capital based on market value proportions. So calculation of overall cost of capital. Okay, we can follow this approach. The type, basically the source, the cost, amount. In this case, amount will be based on market value. And based on the amounts, we calculate the weights. And then we do the cost and weight multiplication. I get the weighted cost or I get the product. So I have equity, then preference shares, then retained earnings, and please observe, I'm writing retained earnings and then cancel it. Why? Because when I say market value approach, this is not considered, not relevant, not relevant in market value weight. Why? Because when I do market value of equity share capital, that includes market value of retained earnings. So don't take it. Then we have debt. Then we have term loan. So the cost of equity, 16%. Cost of preference shares. Oh, okay. I think I did some typing mistake, I think, in the cost of debt calculation. Looks like people are not identifying that mistake also. I don't know if you're calculating yourself. 8.1 plus 3.33 by 90 into 100. I think you get 12.7 cost of debt. Anyway, preference shares 15.43. And return earnings, I will not take it because market value proportions. Debt 12.7. And cost of term loan 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. 9%. Okay, then amount wise, please be careful. Market value to be taken. So we have 15 crores, and then shares of 10 each means 1.5 crores, and 1.5 crores multiplied by market price of 40 rupees. So 1.5 crores multiplied by 40 rupees. So 60 crores. Then preference shares, we have 1 crore of 100 each. So 1 crore divided by 100, I think you get 1 lakh. So 0.01 crore multiplied by 75. So 0.01 crore multiplied by 75. 0.75. Returns will not take it. Debt 10 crore of 100 each. So 10 crore by 100, you get 0.1 crore. And debt market value 80 rupees. You get 8 crore. I think term loan, no market value, will take book value only, which is 12.5. And if I do the total, 60.75, 8, 12.5, you get 81.25. Then you calculate the weights. Weight will be amount divided by total. So amount is 60 divided by 81.25. I'll take 2 decimals. I think if I take 2 decimals, it may be 2 less. I'll take 4 decimals. 60 by 81.25, 0.73846, 0.7385. 0.7385. Then this is 0.75 divided by total 81.25. So 0.75 by 81.25, 0.0092. Then this is 8 by 81.25, 0.09846, 0.0985. 0.0985. Then last 12.5 divided by 81.25. 0.1538. Total approximately should be equal to 1. And it's equal to 1. Then the cost multiplied by weight is the product column. Cost column multiplied by the weight column. So cost into weight. So 16 multiplied by 0.7385. 11.816, let's say 11.82. 15.43 into 0.0092 is 0.14. 12.7 into 0.0985, 1.25. 9 into 0.1538, 1.38. So overall cost of capital, you can say KO, 11.82 plus 0.14 plus 1.25 plus 1.38, 14.59. So this is your overall cost of capital, or also called as weighted average cost of capital. Uh, Another about 5 chapters left out. Uh, we'll take a quick break of 5 minutes for afternoon session. Just face your wash and I'll come. Okay, take a quick break of 5 minutes and we'll continue with the remaining chapters. Remaining, we have about 5 more chapters to go. We should be able to complete by around 5 o'clock. We should be able to complete. So take a break of 5 minutes. We'll continue. Okay. I think we can continue. Okay. Next, capital structure theories. Capital structure refers to the mix of debt and equity. Some people will say debt is good, and some people say debt is bad. There's nothing wrong, nothing right. Different models, different theories have tried to provide their opinions. So we are having different capital structure theories. There's also one more concept between profitability and EPS. We call it as indifference point and break-even points. So what is the financial break-even point? Break-even point means where we break even. We get no profit, no loss situation. For financial statements, ultimate profit is EPS, earnings per share. So it is the EBIT at which EPS becomes zero. That is financial break-even point. Then indifference point, if I'm comparing between two alternatives, when EPS becomes zero, EBIT, the level of EBIT at which both alternative give same EPS, that's called as indifference point. And how it is calculated? Using this formula, EBIT, maybe you can take it as X, minus interest under first category, first alternative, into 1 minus T. So basically EBIT minus I, you get EBT before tax. Then to get after tax, I multiply by 1 minus T, you divide by number of equity shares under first alternative. Same formula you tried at second alternative, EBIT will be unknown. You solve for EBIT. At that level of EBIT, both alternative provide same EPS. That EBIT is called as indifference point. Why it is indifference point? Because at that point, both will provide same EPS. You can choose which one is better. They are not different. So it's called as indifferent. And then comes to capital structure theories. One basic formula you have to keep it in mind, that there is something called as value of firm, which is debt plus equity. If I give one basic example, I keep giving same example. If I take a loan of 40 lakhs and if I put in money of 60 lakhs, so debt 40 lakhs, my own money is 60 lakhs. So value of the house I take worth 1 crore. So from the house point of view, business point of view, that is called as value of the firm. From owner point of view, that is the value of equity. And we are going to calculate so many calculations like cost of equity, cost of debt, overall cost of capital. And one basic structure you can keep it in mind. To calculate any income, the percentage is multiplied. Whereas to calculate the value of investment, then the percentage is divided. In the sense, if I have a fixed deposit of 1 lakh and the rate of interest is 8%, 1 lakh into 8%, 8,000. So to get the income, the percentage is multiplied. On the other hand, if I want the value of the firm back, then interest divided by rate of interest, income 8,000 divided by 8% will give you 1 lakh. So basic structure you understood. To compute the income, annual income, percentage is multiplied. To compute the original value of investment, the same percentage is divided. And to calculate the percentage, income divided by investment, like return on investment, return numerator, investment denominator. Okay, so broadly we have 4 theories, 3 theories which has formula. Net income approach, which says Among the cost of equity and cost of debt, the cheaper source of finance is cost of debt. And if you add more and more debt, the overall cost of capital comes down, and because of the cost of debt being the cheaper source of finance. So net income approach basically says adding debt is good, overall capital comes down. Net operating income approach says that is not right, because one, I agree with you, when cost of debt, you say it is beneficial, cost of debt is cheaper source of finance, that is true. So when you increase the proportion of debt, the cost of capital comes down, I agree. But if company starts taking more debt, the shareholders will have a higher risk, and therefore the cost of equity will increase. The benefit of cost of debt will be compensated, offset by cost of equity, and therefore value of the firm will remain same. So basically, net income approach says the cost of equity remains same, KO changes, in fact reduces. Net operating income says KO remains same and KE changes. That's the fundamental difference. And Modigliani-Miller approach also supports net operating income approach, and he also go one step further and explain through an arbitrage process how it is beneficial for the leveraged firm to move into unleveraged firm shareholding, or unleveraged firm shareholding to become the leveraged shareholding through an arbitrage process. Arbitrage means between the two markets, the price should be same. If not, you can move from lower price to higher price. You can sell in, buy in lower price and sell in higher price. Over a period of time, the price equilibrium maintained. That is the structure of Modigliani-Miller. And we also have traditional approach. Traditional approach says that uh, it is an intermediary approach between net income and net operating income. So it says cost of capital comes down up to a particular point where cost of equity does not change. After a particular point, KO changes, because after a particular point, if company takes more debt, KE will increase. Anyway, these are the broad structure of capital structure theories. I will take one problem. I'll give a simple format in which all these formulas can be presented in a simple manner. And then I have to go for one more area that's called as leverage. So before that, let me take a problem on capital structure theories. Ample Limited operating income is 5 lakh. Cost of debt is 10%. Currently, firm employs 15 lakhs of debt. Overall cost of capital 15%. You are required to calculate value of firm cost of equity. Follow this structure. Any problem in the capital structure things you can solve in a faster manner without mistakes. Okay. So income statement. Okay, income statement goes like this. Net operating income minus interest cost will give you net income. Net operating income, nothing but EBIT. Net income is nothing but net profit or profit after tax. Net profit. Or you can say profit after tax. I will say PAT. Usually all these theory assume no tax. So PAT and profit before tax both are equal. Then income statement you will have valuation or capital structure. Okay. So for net operating income, you write KO. For interest, you write KD. For net income, you write KE. Net operating income, you divide by KO, overall value of the firm. Interest, you divide by KD, cost of debt. Net income, you divide by KE. So when net operating income is taken, what you get is value of firm. And for debt, what you get is value of debt. So value of firm minus value of debt is, or net income by KE, and this is value of equity. Have this format of structure, you can solve any capital structure problem in a smooth manner. Very simple. Whatever information given, you have to put in the right place, and remaining you can calculate automatically. So operating income of 5 lakh, net operating income 5 lakh, cost of debt 10%, KD 10%, currently employs 15 lakh of debt, value of debt 15 lakh, overall cost of capital 15%, KO 15%. That's all. So you calculate one by one. You see, we have net operating income. I can calculate interest, debt 15 lakh into rate of interest 10%. So net interest is 1,50,000. So net income 5 lakh minus 1,50,000, 3,50,000. Now you compute the value of the firm. This, let me say, working note number one. Value of the firm. Corresponding income is net operating income divided by KO. Remember my words. To compute the income, the percentage is multiplied. To compute the value of investment, percentage is divided. We are calculating value of the firm. Corresponding percentage is KO, 15%. You divide it. So 5 lakh divided by 15%. You get 33 lakh, 33,333. This is the value of the firm. Then value of debt, 33 lakh, 33 minus 15 lakh is with debt. Value of equity, 18 lakh, 33,333. Firm minus debt is equity. So how do we get cost of equity? This, let me say, working note number two, to compute the income, rate of interest, income by investment. So cost of equity, you can calculate as net income divided by value of equity. Of course, to express in percentage, you can multiply it by 100. So net income, 3,50,000 divided by value of equity, 18,33,333 into 100 to keep it in percentage. 3,50,000 by 18,33,333, you get around 19.09%, and this is your cost of equity. All calculation, you got it. So follow income statements and then the valuation. Income statement, net operating income minus interest is net income. Divided by KO, divided by KD, divided by KE. You get value of firm, value of debt, value of equity. Fill up the numbers, which are information available. Start calculating the other. You'll be able to calculate in a simpler manner. Use this method. I'll really tell you, it'll help you a lot. Okay, let's move on further. Leverage. In the capital structure theories, one more concept is leverage. Leverage means technique of multiplying losses. Profits also multiplied, loss also multiplied. Higher leverage means higher risk. Why risk exists in the income statement? Primarily because of fixed cost element, which is fixed operating cost and interest cost. To reflect this, we have three types of leverages: operating leverage, financial leverage, combined leverage. Operating leverage is reflecting business risk, operating risk, existence of fixed cost is explained by operating leverage. Formula, contribution by EBIT. Financial leverage reflects financial risk, existence of fixed interest, fixed financial cost is explained by financial leverage. Formula, EBIT by EBT. Combined leverage is overall risk, combination of operating leverage and combined leverage. So you can say OL into FL, or you can also say contribution by EBT. So basically, leverage will try to understand relationship between various variables within income statements. So in income statement, you have sales as the starting one, and ending you have as the EPS. And in between, let's say we have something like EBIT, which is your operating income. So what changes between sales and EBIT? If sale changes, how much EBIT will change? This is given by operating leverage. So if sales is 10%, operating leverage is 3, EBIT will change by 30%. So if sales changes by a percentage, how much EBIT will change? That is operating leverage. And from EBIT to EPS, what connects is financial leverage. If EBIT changes, how much EPS will change? And from sales to EPS, that is given by combined leverage. And percentage change in EPS is equal to, when I say percentage change in EPS, will be equal to percentage change in PAT. And this will be equal to percentage change in earnings before tax. Why? Because all of them are proportional in nature. EPS is obtained by profit by number of shares. So whatever profit changes, EPS also will change by same percentage terms. EBT and PAT are by tax rate. Tax rate will remain same proportionately. Unless there is preferential dividend, percentage change in EPS is equal to percentage change in PAT is equal to percentage change in EBT. This much if you know, leverage is sufficient. Let me do a problem to understand this concept. Yeah. A company produces and sells 10,000 shirts. The selling price per shirt is 500, variable cost 200, operating cost 25 lakh, interest cost 1 lakh. Calculate your operating financial combined leverage. If sales up by 10%, then what is the impact on EBIT? If sales by down by 10%, then what is the impact on EBIT? Okay, let's write income statement. We start with sales. 10,000 shirts multiplied by selling price per shirt, 500. So you get 50 lakh minus variable cost, 200. So 10,000 shirts into 200, which is 20 lakh. So selling price minus variable cost. So you get contribution of 30 lakh minus fixed cost, fixed operating cost 25 lakh. So you get EBIT of 5 lakh, interest cost of 1 lakh. So minus interest 1 lakh. So you get EBT of 4 lakhs. So first one, calculate the various leverages. So operating leverage, contribution by EBIT, contribution 30 lakhs, EBIT 5 lakh. So operating leverage 6 times. So if sales changes by 1%, operating leverage change by 6%. Financial leverage EBIT divided by EBT. EBIT is 5 lakh. EBT is 4 lakh. So 5 lakh by 4 lakh, I think you get 1.25 times. combined leverage, that is, you can say financial leverage into operating leverage, or contribution divided by EBIT. So contribution is 30 lakh, EBT is 4 lakh, 30 lakh by 4 lakh. 7.5 or 6 into 1.25. That also will give you 7.5. Okay, second point. If sales are up by 10%, if sales are up by 10%, what is the impact on EBIT? So what connects between sales and EBIT? Operating income is operating leverage. So percentage change in EBIT equals, what is the percentage change in sales multiplied by operating leverage? Percentage in sales is 10%, operating leverage is 6. So EBIT will change by 60%, increase in EBIT. You can also verify if sales increase by 10%, 50 lakh become 55 lakh. You calculate these things, EBIT would have changed by 60%. You can check it later. Third part of the question, if sales are down by 10%, if sales are down by 10%, what is the impact on EBT? So percentage change in EBT equals percentage change in sales multiplied by combined leverage. So if sales are down by 10%, so minus 10%, combined leverage is 7.5. So EBT would have changed by 75%, minus 75%. 10% fall, tax will EBT will be down by 75%. You can check it. If sales 50 lakh is down by, previously I told 60%. 5 lakh would have increased by 60%. So when sales are down by 10%, 50 lakh will become 45 lakh. This 4 lakh would have been down by 75%. Means 4 lakh would have become 1 lakh. You can check it. Anyway, so this one problem should give you conceptual understanding about leverages. Okay, so what we discussed now is the chapter on capital structure theories and leverages. Let's go to the next topic, next chapter. Okay, so next topic we have is on dividend decision. Okay, dividend decisions. Whether company should pay dividend or not, again, there is no specific fixed answer that it is right or wrong. Company like Infosys pays frequent dividend and they are into information technology sector only, but growing well, making good profits. Reliance Industry hardly pay any dividend because they believe in expansion. Whatever money they earn the business, they keep investing in new business. That's why you see Reliance there everywhere. So Infosys want to be only in IT sector. They don't want to expand. That's fine. Reliance is aggressive. They want to expand elsewhere. That is fine. So they make use of policy of non-payment of dividends. So dividend is not specifically said to be good to be paid or bad to be paid. So different theories have come and I've explained their approach. From exam point of view, broadly, you have three important theories. One is Walter approach, then Gordon growth model, and Modigliani-Miller hypothesis. So all three of them, I'm going to solve the problems quickly. First, coming to the Walter approach, he says the value of the firm, market price, theoretical market price, in his opinion, P0, is combination of two things. What is distributed profits, DPS, undistributed profits, EPS minus DPS. And undistributed profits will grow. So you multiply it by RA for return on investment, return on assets, and you divide by RC, cost of capital, return on capital. And the Gordon growth model, it's basically dividend discount model. He actually calculates the dividend forever, D1, D2, D3, D4, D5, then he discounts. The mathematical portion formula, when you look like, it looks like D1 by KE minus G. So formula looks, I'm making use of only first year dividend. No, my dear friends. It is using dividend forever. Mathematically simplified formula is KE minus G. So D1, or you can also write D0 into 1 plus G. That is depending on what type of dividend available. Dividend expected means D1. Dividend just paid or paid for the last year means D0. K is cost of capital, G is growth rate. Sometimes growth rate may not be given. That is given by B into R, B for retention ratio, R into return on investment. Then we have Modigliani-Miller hypothesis. Just like in capital structure theories, who said debt does not impact the value of the firm. Here he says dividend does not impact the value of the firm. And he says that that's why it's also called as dividend irrelevant theory. Dividend has no impact on value of the firm. And he also proves by two situations. If company pay dividend, if company don't pay dividend, he proves value of the firm is remaining same. And in that proof, he assumes one thing here. To compute the price, he will take P1 plus D1 divided by 1 plus KE. Price after year 1, P1. Dividend after year 1, D1 divided by 1 plus KE. And to compute the value of the firm, he assumed this formula, new shares plus old shares into P1 plus income minus investment. Why it is new share, old share? Because he says, if company pay dividend, cash outflow will be there. And to compensate for that, you have to issue shares. You have to issue more shares. And if you don't pay dividend, you have to issue less number of shares. So ultimately, the payment of dividend is compensated by issue of shares. So value of the firm will remain same. So he assumes this formula to explain his situation. Let's solve some problems on these approaches to get practice or to be prepared for dividend discount models. Star Limited is having share quoted in major stock exchanges. Share market price after dividend is 20%, having capital of 20 lakhs. Annual growth rate is 2%. Expected on equity is 15%. Calculate based on Sterlite Limited based on Gordon's model. Okay. It's only a Gordon's model, not on Walter model. Walter model, again, DPS plus EPS minus DPS, I think you can follow it. Okay. So Gordon's model, based on Gordon growth model, formula P0 equals D0 into 1 plus G divided by KE minus G. D0 is dividend just paid, 20% dividend on face value of 10 rupees. So 10 into 20%, that is 2 rupees. Expected return on equity 15%. So KE is 15% or 0.15. Then growth rate is given to be 2%. G is 2%. So substitute D0 2 rupees into 1 plus growth rate 0.02 divided by K minus G 0.15 minus 0.02. So 2 into 1.02 divided by 0.13. So these are all theoretical market prices. In their opinion, what is the price per share? You get 15.69. Okay, let me do one problem on theory, M&M approach. RST Limited has capital of rupees 10 lakh in equity shares of 100 each. Shares are currently quoted at par. Company proposes, oh, I thought only human propose, company is also proposing. Company proposes to declare a dividend of 10 per share at the end of current financial year. So D1 basically. Capitalization rate for which cross company belongs 12%, that capitalization rate is cost of equity. What will be the market price at the end of the year? P1. If dividend is not declared, dividend declared. Assuming company paid dividend of and net profits of 5 lakh and makes a new investment of 10 lakh, how many new shares must be issued? Use model. Okay, first part of the question, they're asking if dividend is not declared, if no dividend. So formula for you use as per model, P0 equals price after year 1 P1, dividend after year 1 D1, and discounted by 1 year 1 plus K. This is the formula as per model for price calculation. And currently quoted par, so P0 is 100. So 100 equals P1 is what we need to calculate. And no dividend. So D1 becomes 0. Capitalization rate 12%. So 1 plus 0.1. Cross multiply 100 into 1.12 is equal to P1. So P1 basically price after year 1 is 112. Second part of the question, if dividend is declared, if dividend equals dividend per share, 10 per share. If dividend equals 10 rupees. Same formula use. Current market price 100 equals P1, which is what we need to calculate. D1 is 10 rupees divided by 1 plus 0.12. Cross multiply 100 into 1.12 equals P1 plus 10. 10 goes to left side. So 112 minus 10 equals P1 or P1 equals 102. So price if dividend is paid and if dividend is not paid. And last one, how many new shares must be issued? New shares to be issued. And how do you calculate the new shares? Whatever the amount to be raised by price per share. Issue price. Price per share. And price per share, we just calculated now. If company pays dividend, the price per share will become 102. Amount to be raised, we have to calculate. If you pay dividend, how much profit will go out and how much will remain. So let me calculate here. Your net income for the year is 5 lakh. You can see net profit 5 lakh minus dividend paid. How much dividend is paid? You pay 10 per share. How many shares? 10 lakh divided by 100, which is 10,000 shares, and 10,000 shares multiplied by 10. So 10,000 multiplied by 10. So 1 lakh dividend is paid. Therefore, retained earnings is 4 lakh. Once you pay dividend, reserves will come down, profit will come down, remaining 4 lakh. But how much investment you are planning to make? Investment 10 lakh. So if I subtract investment of 10 lakh, how much is the shortage? 10 lakh is the investment. 4 lakh is retained earnings. Remaining 6 lakhs, how do you raise? Is by issue of new shares. So this is the amount raised, amount to be raised by issue of shares. So now if I substitute, amount to be raised is 6 lakh, price per share is 102, you'll get the number of shares. So 6 lakh divided by 102, 5882.35. So number of shares to issued is 5882 shares. One typical question, definitely you can expect an exam. Most probable problem you can see. Okay, let's go further. Next chapter, working capital. Working capital is the amount required for day-to-day purposes. Simple formula for working capital is current assets minus current liabilities. And another way in which you can approach is called as operating cycle, or also called as cash conversion cycle. How much time it takes to convert cash to cash. Because you start from cash, it becomes raw material become work in progress become finished goods become debtors, customers, then you get the cash. This whole cycle is called as operating cycle. And from exam point of view, they can ask you to calculate based on overall working capital estimation. Basically, we do current assets minus current liabilities. Or they can ask you specifically with respect to things like inventory management, like they'll ask you inventory levels. So many formulas are there. At this point in time, I'll not be able to cover all, but I'm just letting you know. Things like EOQ, square root of 2AB by C, A for annual requirement, B for ordering cost, C for carrying cost per unit per annum. They can ask you reordering level, they can ask you reordering quantity. Reordering level is like, a maximum level into maximum consumption to maximum lead time, like that inventory management. Receivable management, they can ask you whether the credit policy evaluation should be done from 1 month to 2 months, where you have to calculate how much profit you get, how much cost, net benefit, positive or negative. But one of the repeated question in the exam is on overall working capital estimation. So keeping in mind the examination point, I will solve problem on that area. Overall working capital estimation. So take a look at this. A pro forma cost sheet is given. Material, labor, overheads. Following further informations are available. Raw materials are in stock on an average for 1 month. Materials are in process. On average, half a month is okay, middle process. Finished goods are in stock for average 1 month. Credit allowed by supplier in 1 month, credit allowed retires 2 months, lag in payment of wages 1.5 weeks, lag in payment of overheads 1 month. 1/4 of output is sold against cash. Cash on hand is 25,000. You are required to prepare a statement of working capital needed to finance the level of activity for 1,04,000. You may assume product is carried evenly throughout the year, various overheads accrue similarly, and the time period for 4 weeks is equivalent to 1 month. So what you're going to do, you're going to estimate the current assets and current liabilities on proportionate basis. So for example, this is institute solution. I'll take the institute solution. Calculation wise, they have given some confusing ones. I'll try to give my opinion of my method of solving numbers. But I'll take institute number so that the calculation can be done faster. Okay, now you have to understand something like a cost sheet. Okay, so material 80 multiplied by number of units. You can multiply this by number of units, which is 1,04,000 each of them, which will give you annual cost of material, annual cost of labor, everything annual cost, and annual sales. So if I calculate quickly, 1,04,000 into 80, 83,20,000, then 1,04,000 into 30, 31,20,000, then 1,04,000 into 60, 62,40,000. Then 170 into 1,04,000, 1,76,80,000. Then 200 into 1,04,000, 2,08 lakh. Okay. Now keeping this in mind, let's calculate the estimation of current assets. Now coming to stock of raw materials. Now raw material on stock average for 1 month. So 83,20,000 is full year. How much for 1 month? 83,20,000 multiplied by 1 by 12, 1 month. 83,20,000 divided by 12, you get 6,40,000. What institute has done? Let me just explain also. They said you take 4 weeks as 1 month, right? So they have taken 4 by 52. You understand what institute has done? 83,20,000 into 4 by 52. They got 6,40,000. They did not do 1 by 12. They did 4 by 52 because they have taken 1 month as 4 weeks. They said, right? 4 weeks equal to 1 month. So they have taken 4 weeks equal to 1 month equal to 4 weeks. So instead of doing 1 by 12, they did 4 by 52. You got 6,40,000. You can do otherwise also. No problem. Don't worry. You can do 1 by 12 also. Okay. Similarly, now coming to raw material. Raw material is done. Finished goods. Now finished goods total cost is 1,76,80,000 full year cost, and finished goods are in 1 month. Again, I can do 1 by 12 or they did 4 by 52. I'll follow their approach. 1,76,80,000. 1,76,80,000 multiplied by 4 by 52. You get 13,60,000. So you got this. Work in progress. Work in progress is for half a month. On an average, half a month. But only problem with respect to work in progress is they're not fully complete. So you have to take an average. You can say it is assumed 50% completion, something like that. Yeah, so they have calculated the work in progress. If I calculate on an average, half a month means I can say 2 weeks. So uh, I'll just show institute solution also. It will be faster for me to write. We are moving towards the end. So 2 weeks basically. So work in progress, we usually assume if nothing is given, material is 100% complete, wages overheads are 50% complete. So regarding the material portion, what is our material cost? 80 rupees. And I also calculate numbers, sorry, I forgot. What is the number? 80 rupees into 1,04,000 was 83,20,000. So in WAP, material component will be there, labor component will be there, overheads component will be there. So material 83,20,000, and this is for a period of 2 weeks. So I'll take 2 by 52, half month. So 83,20,000 into 2 by 52, you get 3,20,000. As far as labor is concerned, 30 into 1,04,000, it was 31,20,000. So this also I should do 31,20,000 into 2 by 52, but this is 50% complete. Usually nothing is given when they tell you accruing evenly throughout the month. When you start, it is 0%. When you finish 100%, so average 50%, 0% divided by 2. So 31,20,000 into 2 by 52 into 50%, you get 60,000. And similarly, this was 62,40,000. That was the overheads, right? So 62,40,000 into 2 by 52 into 50%, you get 1,20,000, and that is 5. Now, as far as debtor is concerned, we will value the debtors also on cost basis because we don't want to include profit in the amount of funds blocked. So regarding debtors, credit allowed by supplier 1 month, credit allowed to debtor is 2 months. So 2 months means we'll take it as 8 weeks. And the same cost what it took for finished goods, we'll take it here. That is 17 lakh 6 1 crore 76 lakh 8,000 80,000 multiplied by 2 months. So 8 by 52. 1 crore 76 lakh 80,000 into 8 by 52, you get 27 lakh. What they have done? Okay, sorry. It is sold, 1/4 of the output is sold against cash. So we should take only 3 by 4. What is sold on credit sales? So you can multiply this by 3 by 4. So into 3 by 4, you get 26 lakh 40,000. 20 lakh 40,000. Cash balance 25 lakh. You get it. That is given in the problem. Then current liabilities portion. Current liabilities, raw materials. What is the time given by supplier? 1 month. Again, we'll take it as 4 weeks. So raw material cost 83 lakh 20,000. 83 lakh 20,000 is for full year. How much for 4 weeks? So 83 lakh 20 into 4 by 52, we get 6 lakh 40,000. Similarly, lag in payment of wages, 1.5 weeks. And overhead is 1 month, means 4 weeks. So annual overheads into 4 by 52, annual wages into 1.5 by 52. Respectively, you get wages and overheads, and current assets minus current liabilities, you get working capital. So this one typical problem being asked in examination towards overall estimation of working capital. This one problem, if you practice, it should give you good confidence. Okay, so that is on estimation or working capital. Let me just calculate for you. Why should I leave wages and overheads? Because if you're following our method, you should know. If it is wages, 31 lakh 20,000. So 31 lakh 20,000 multiplied by 1.5 weeks. So 1.5 by 52. You get 90,000. Then overheads, 62 lakh 40,000 into 4 weeks, 4 by 52. 62 lakh 40,000 into 4 by 52, you get 4 lakh 80,000. So working capital estimation, keep it simple. Calculate the annual cost multiplied by the holding period. Annual raw material consumption, if the raw material is 2 months, into 2 by 12. Annual cost is 12 lakhs. If the finished goods for 1 month, into 1 by 12. Debtors, you take it at cost, and if anything is sold against credit, only that you take it. Like they say 20% sold for cash, then 80% on credit basis. In this problem, 1/4 is sold against cash, so 3/4 is on credit basis. A raw material, usually we take 100% complete material in WIP, whereas labor 50%, overheads 50%. This is the assumption of percentage of completion with respect to WIP calculations. Then this should give you, if you practice these kind of problems, sufficient for examination to prepare on this. Let's move to the next topic. Security analysis. Security means a share or a instrument traded in the market, bought from one person to another. Because many people in the market simply buy without looking at its fundamental, without understanding about the company, by looking at some Telegram tips, WhatsApp messages, YouTube videos, people buy the stock. This chapter will tell you, don't buy the stock like that, do some kind of analysis. So broadly, there are two types of analysis can be done in analyzing investment in a company. One is called as fundamental analysis and other is called as technical analysis. Fundamental means looking at the fundamentals of the company such as ratios, financial statements, profitability, growth aspects, product of the company, promoters, their history. We do economic analysis, which country the company belongs to, industry, what is the product life cycle, are they affected by AI, are they benefited by AI, company analysis. So if I say software industry is good, then within software industry, which company is good? These things are called as fundamental analysis. We look at earnings yield, fair value, dividend discount model, various cash flow method are used, various valuation methods are used. So looking into the fundamental nature of the company, its operation, products, profitability, promoters is called as fundamental analysis. Then technical analysis. In fact, Rakesh Jhunjhunwala sir used to say, I look at fundamental analysis to identify which stock to buy and technical analysis to understand when to buy, when to sell. So basically, technical analysis is the looking at charts, patterns. So if you look at the chart, something goes like this. So every time you say, oh, this is the peak. If it reaches this point, this you should sell. This is the bottom. If it comes to this point, then you should buy. So looking at the charts, patterns, indicators, we make a decision to buy or sell. That's called as technical analysis. Technical analysis has a fundamental assumption of history will repeat. See, next time if it goes down, it comes up, we assume again we have to sell, but here it can go up again. It's actually called as breakout. This bottom point is called as support. Upper point is called as resistance. And if the resistance is broken, that becomes support next time. So these kind of patterns, charts, trends, indicators is called as technical analysis. A few points, few patterns to identify. Head and shoulder pattern. So like a head and shoulder, like it goes up, then it comes down, something goes up, it comes down, and then it flattens. So it's look a head and shoulder, right? These are shoulder, this is head. So this pattern we identify. Cup and handle pattern. So the stock price goes like this, then it comes down, again it goes up, it comes down. So you can see this is like a cup and handle. So this chart is called as cup and handle. So like this, they are having various charts, categories, patterns that is done in technical analysis. And also you are going to calculate many indicators, like you calculate average, moving average, exponential moving average to identify the trend of movement, whether upside or downside. And technical indicators also there, like some RSI index, a Finch indicator, Fibonacci series. So many are there, they are there. Then certain theories also can be asked. Dow Jones theory, DJ theory. Dow Jones theory basically divides into three categories of movements. Now, long-term movement, medium-term movement, short-term movements. Long-term movements may be in years, short-term movement may be in months, and medium in months, daily in days. Short-term, medium-term, long-term fluctuations. So sometimes long-term may be upward, day-to-day wise it may be short-term because of news coming, war news like that. So that is what Dow Jones theory. Random walk theory says that stock market movements cannot be predicted. It's completely random, like a walk, the steps of a random walk person. How can a drunkard person will walk? That's how the stock market movements cannot be predicted. That's against technical analysis. We can't predict. Random walk theory. Efficient market theory basically assumes market is perfect. Nobody can beat the market. Even with some people telling that, some experts tell, don't invest in mutual funds, PMS. Invest only in index funds because market is perfect. Market has taken all information. Market is supreme. People also say, Bao Bhagwan Che, like price is like God. Anyway, returns calculation by some formula, they can ask you P1 minus P0, what is the current price, what is the new price difference, plus any dividend received by P0. If many years returns are there, we are going to calculate an average. Standard deviation and all is there. I don't want to confuse you with this. CAPM model comes here also. So if I write a chart, x-axis representing risk, which is beta, and y-axis representing return. So I should always start with risk-free rate, and higher the amount of beta, meaning higher the amount of risk, higher the amount of return that I can be expected is CAPM returns. And we also have two types of risk. Theory question can be asked. Systematic risk and unsystematic risk. Systematic risk means which occurs in macro environment, inflation risk, political risk, social risk, GDP, political stability, AI movement, in larger what is happening, systematic risk is macro, nobody can control it. Unsystematic risk is with respect to specific companies. See, Corona happened, that is systematic risk. Now, Infosys chairman Narayan Murthy resigned, particular risk, that is unsystematic risk. Micro economic risk. So when the changes happens with respect to the entire economy as a whole, like Corona happened, GST introduced, demonetization happened, Brexit happened, systematic risk. Nestle was announced as unfit for consumption. Some news came in. Then Maruti Suzuki lockout happened. Narayan Murthy resigned. So this particular thing, Yes Bank scam came out. So these things are particular to company called as unsystematic risk. Now, unsystematic risk can be avoided by diversification. If you are cross invest, you through better diversification, unsystematic risk can be maintained better portfolio, but not possible in a systematic risk. Systematic risk is by macro factors, and only macro factors can give you the compensation. Then coming to, okay, one problem on CAPM valuation and whether it is connected with our dividend model, whether it is overpriced or underpriced, we can comment using CAPM and dividend discount model. So let's solve one problem based on that. ABC Limited has been maintaining a growth rate of 10% in dividend. Company has paid a dividend of 3 per share. Rate of return on market portfolio 12%. Risk-free rate is 8. Beta is 1.5. You are required to calculate the expected return using CAPM and equilibrium price using dividend growth model. Okay, the two things here. One is CAPM model. And then we have dividend growth model. Now using CAPM, cost of equity is RF, risk-free rate, minus plus RM minus RF, market rate minus risk-free rate into beta. In this problem, risk-free rate is 8 and market return is market portfolio 12 and beta is 1.5. So 8 plus, this is 4 into 1.5. I think this is 6. 6 plus 8, you get 14%. Now dividend growth model, P0 equals D0 into 1 plus G by KE minus G. D0, dividend just paid, dividend of 3 rupees, and they're maintaining a growth rate of 10%. So 3 into 0.10 divided by KE minus G. Cost of equity, we just calculate 14%. 14% means 0.14. And growth rate is 10% in dividends, 0.10. So 3.3 by 0.04. 82.5. So as per dividend discount model, the share price should be 82.5. If in the market, if it is trading at 85 rupees, it is overpriced, we say don't buy, sell it. If in the market trading at 80 rupees, market is undervalued. So because worth is 82, market is 80 means it is definitely to be purchased in the market, available at a lower price. So market price is more, overpriced, sell it off, don't buy. If market price is less, underpriced, recommended to be bought. If it is equal, you can say hold. So this is the one of the small problems associated with the security analysis. Let's go to the last chapter, chapter 19. Let us know the important chapter to focus more in CA as well as in FM. Whatever the problems we did in this session are important chapter, I would say. Problems we solved, right? Working capital solved, cost of capital we solved, consolidation we solved, cash flow we solved. Whichever problem we solve, they are going to be coming in exam. You can give higher weightage. Okay. Last chapter, operational aspects to financial decision, is about the actually costing syllabus given as one chapter. Main topics I will focus. We have something called as fixed cost and variable cost. Fixed cost move in tandem or does not move in tandem with production volume. Variable cost move in tandem with production volume. So sales minus variable cost is called as contribution, and contribution divided by sales as a percentage of sales, that's called as profit volume ratio. And contribution minus fixed cost becomes profit. And one important term to understand here is break-even point, at the point at which we recover all our costs, no profit, no loss. And formula for break-even point is fixed cost divided by PV ratio or contribution per unit. If I do contribution per unit, my answer is number of units. If I divide by PV ratio, then my answer is rupees in sales. And there is once also margin of safety. Margin of safety is over and above break-even point, how much you can get. To simplify, I have one way in which you can write the formula better. So let me write it here. So you see, contribution equals sales minus contribution, I will write contribution equals fixed cost plus profit. If I divide by PV ratio, contribution by PV ratio. PV ratio means, contribution by sales into 100. Sometimes they'll give you PV ratio. Contribution by PV ratio is sales. Fixed cost by PV ratio is break-even point. Profit by PV ratio is MOS, margin of safety. So sales can be calculated as contribution by PV ratio, or it can also be calculated as break-even point plus margin of safety, MOS, margin of safety. Like this, different possible combinations. Using this one structure, you can get the formula. You can get the answers. Okay, let's read this question one. The following data related to manufacturing company: plant capacity 4,000, 4 lakh, percentage utilization 40%, means 4 lakh into 40%. Only 1,60,000 they are producing units, only 40%. Selling price 50, material cost 20, variable 15, fixed 27. In order to improve the capacity utilization, the following proposals are conducted: reduce the selling price by 10%, spend additionally 33 lakhs. How many units should be sold in order to earn a profit of 5 lakhs per year? Okay, let me just solve this question for you. I think the institute would have solved institute solution. Let me just take the help of institute so that we can look at the answer faster. Or okay, let me solve it. Institute solution will do it in their own way. I will solve it quickly using my method. Okay. So first, let me calculate certain existing income statements. Okay, existing income statement. If I calculate, what is the sales? 1,60,000, 4 lakh into 40%, 1,60,000 units. Selling price 50 rupees. Selling price 50 into 1,60,000. So 80 lakhs. Minus variable cost means materials 20 and variable 15. So 20 and overhead 15. So 35 into 1,60,000. 56 lakhs. This is the variable cost. So contribution 24 lakh minus fixed cost 27 lakhs. Oh, you are having loss, I think, of 3 lakh. I think that's what they want to improve. In order to improve capacity utilization, reduce selling price by 10%. So revised, what is the new selling price? 10%, reduce. So 50 rupees minus 10%. So 5 rupees means it becomes 45. And spend additional cost of 3 lakhs. So what will be the new fixed cost? 50, already having 27 lakh plus 3 lakh. So you will have new cost of 30 lakhs. And variable cost for you 35 rupees. That will remain same. Variable cost will remain same at 35 rupees. Therefore, what will be the contribution per unit if I calculate? Contribution per unit. Selling price 45, variable cost 35, contribution per unit is 10 rupees. Now, I need to cover fixed cost of 30 lakhs. I need to cover profit. What is the target profit? Would like to make a profit of 5 lakhs. So, fixed cost also to be covered, profit also to be covered. Remember the formula, like contribution equals fixed cost plus profit. So fixed cost is 30 lakhs. Profit we want to achieve 5 lakh. So contribution 35 lakh. So contribution per unit is 10 rupees. And I have to make a contribution amount of 35 lakh. So what will be the number of units? How many units? 35 lakh divided by 10. That is 3,50,000. So at present, you're having 1,60,000. If I make it into 3,50,000, then almost double, I think, more than double. My loss of 3 lakh can be made into profit of 5 lakh. I think existing is not required. I just told you for analysis purpose, revised is sufficient for this problem. Okay, so this is what is the problem or concept relating to operational aspects of decision making, typically called as marginal costing. You should know sales minus variable cost is contribution minus fixed cost is profit. And to get the break-even point, we do fixed cost divided by PV ratio or fixed cost by contribution per unit. And we want to achieve certain target profit like this, then fixed cost plus profit divided by PV ratio or divided by contribution per unit will get to the target units to be produced and sold. Okay, so that's what about the day's session is all about. Started with corporate accounting and now we're ending with financial management. All I can say is only one thing. You have to practice more and give more preference to study material rather than any other materials. I hope this session was useful. And I'll also share my mobile number, email ID in case you want to reach out to me or if you have any doubts. So this is my mobile number 95350 78357. And my email ID hegde87 HEGDE 87 at gmail.com. Okay, so you are definitely welcome to ask your doubts. you can either directly contact the office, the Excel Academy's office number, or you can also message me. I may not be able to get the reply instantly, but I'll try my level best to reply at the fast. I hope the session was useful and benefiting your preparation. I'll just conclude the session with my last one statement. Usually that will be my last statement everywhere. Most people live as if they don't die, and most people die as if they have not lived. Only few people will be alive even after their death, because when they were alive, they made the difference to others' life. I wish each and everyone to be one among this, and all the best for examination, and thank you for spending time. Take care. See you. Bye-bye.